Hello, my name is Debbie Robinson. I'm Director of Business Development and Events at M. Robinson and Company Tax Law Specialists. Some people have asked, so I'll answer definitively. Morris Robinson is my husband, Yale Robinson is one of our sons, and the baby, Bracha, who is finishing up medical school, is outside studying for her board exams, but she's here. So I want to acquaint you with your study packets. CPAs who wish to earn continuing professional education credits should be sure to fill out this form. It is a two-sided form. Be sure to fill out at the top your name, your phone number, and your email address. Our office has to save this form for 3 years, just in case the Board of Public Accountancy asks us for proof that you attended today. And as proof, we need you to fill out your evaluation of the speakers on both sides. There's an optional section for everyone here, not just the CPAs. If you are willing to write a 5-star Google review of M. Robinson and Company, please compose 3 sentences about something you learned or why the event was valuable, and we will send you a follow-up email to ask you to fill it in on an online form. When you are done, either leave your form on the table or hand it to me or to Joseph Kelly, who is our paralegal and office manager. He's sitting outside. Moving on to the other side of your folder, this section has the reminder of the Wi-Fi password. If you want to log in with MCLE, you click on the Wi-Fi section of your cell phone or tablet and put in the password, which is welcome1 with a capital W. This is a list of our speakers. We have Morris Robinson, Yale Robinson, Cheryl Morse, enrolled agent who has just come in from Emerging Business Partners, Inc., Michael Rose, certified financial planner, Masters of Science in Taxation from Modera Wealth Management, sitting in the back row, and Alexander Rodriguez, an attorney with an MBA from Blockchain Legal. I think he is not yet here.
He'll be around 4 o'clock.
Right. The email addresses of each of our speakers are listed. If you have a question that is not answered here today, the speakers will be eager to hear from you and will answer you afterwards. There is also a schedule here, the speaker biographies, and on the last page is information about how you can access the PowerPoint presentations once you leave here by going on to the M. Robinson website. Finally, your study packet contains reprints of 2 articles that were authored by Morris Robinson, Tax-Favored Foreign Income Planning, Pointers and Tracks, and the Qualified Business Income Deduction, which is often called by its initial letters, QBI. And as a layperson, I've heard that this is really one of the hottest topics in taxation altogether. And so I'm glad that some of these topics are being addressed here. And with that, we would like to proceed with our first speaker. And it's usually our custom that if you have a question, don't wait for the break to answer it. Raise your hand, and our speakers will try to acknowledge you right away.
Do you have something to move the slides ahead?
What?
Do you have a tool to move the slides, or should I go to the computer?
Why don't you go to the computer?
All right, I'll be right there. No, there's a clicker here.
Okay.
It works.
How long do I have? About 10 minutes?
10 minutes.
Okay. What I'm going to do over the next 10 minutes is just to provide an overview of what's going on. I'd like to, in addition to talking about just a broad overview of the Tax Cuts and Jobs Act, I'm also going to talk about what I have perceived to be a significant reduction in the quality of services by IRS. First, with regard to the Tax Act. Yeah? Okay. Reduced tax rates. Tax rates are, in fact, reduced for most people. For corporate, the corporate rates are reduced from a maximum of 35% on a graduated scale to a single bracket of 21%. So you're going from a maximum of 35 to a maximum of 21. This is for C corporations. These are corporations that are subject to tax independent of their owners. It also applies, and this is important if you're a lawyer and you want to practice in a corporation. Used to be that lawyers did not practice in C corporations. Why? Because if you were in a C corporation, you were in a personal service corporation, and you were automatically at the maximum tax rate of 35%. Now, you're going to be at 21%. Huge difference. For individuals, you're going from 39.6% as the maximum bracket to 37%, which is a little bit less. But if you are a business owner and you have qualified business income, your deduction is reduced. Your tax rate is reduced by at least 20% on your qualified business income. And of course, there are also special deductions for people who are involved in international business, and I'll talk about that later. Simplifying tax compliance for middle-income Americans. Well, most people are going to have a standard deduction and instead of itemized deductions. So that's going to simplify their tax compliance. Meanwhile, for people who do itemize, they're no longer going to be able to deduct more than $10,000 in state and local real estate taxes, income taxes, whatever. And that has a huge impact in places like Massachusetts, in many of the leafy suburbs, including Newton, Wellesley, Weston, and so on. The real estate taxes can well be $10,000 or more, which means that the income taxes that the people pay who live in these leafy suburbs, there's no tax deduction because you're already at your maximum of $10,000. The alternative minimum tax is eliminated for corporations and it's reduced for individuals, basically through an increase in the exemptions. Taxable estates are reduced. Individuals who pass on, their estates don't have to pay estate taxes unless the gross estate exceeds something like $11 million. For people who are married, it can be $22 million. Basically, it means that if you're involved in estate planning for people, yes, the state estate tax is still important, but the federal tax is not going to be important unless you're servicing the top tenth of 1%, 0.2 of 1% of the population. The individual mandate under the Affordable Care Act is repealed beginning next year. territorial system is established. Basically, used to be that everybody was subject to tax on their worldwide income. Now, not as much, and we'll be talking about this later, but basically, if you set up a corporation abroad, and that corporation does business abroad, the corporation is going to have to, will require its owners to report a certain amount of income, but not particular, but it's going to be very different than it was before, and we'll be talking about that in more detail later. The reduction of reliance of Americans on debt. Many foreign economists, in Europe, for example, say that we are over-leveraged, we pay too much, our debt is too high relative to our income. However that be, the interest deduction on businesses who gross more than $25 million is being curtailed for most Americans in the upper middle class or the middle class even. The mortgage deduction has been reduced to the first $750,000 of acquisition indebtedness. The interest expense deduction for owner indebtedness, home equity indebtedness rather, has been eliminated. You no longer can use your home as a piggy bank and get a tax deduction for it, with an important proviso that if you are using the money in your business, you take from your home equity line and you're starting a new business, or you take from your home equity line and you're investing in a new business or in any business, you will be able to deduct that money. But basically, you have to connect the borrowing with the use of the money. You didn't have to make that connection before. Yes, Debbie?
What kind of proof will be required by the IRS that the money that you borrowed from your home equity line is actually being used to fund your business?
That's a good question, and I think it depends on the facts and circumstances. You just have if for example you borrow from your home equity line and you use it to invest in, say, a new photocopier in your business. You have a small business, you need a photocopier. A photocopier costs $15,000, and you take it from your home equity line. Basically, what I would do is I would simply provide a note if you've got a separate entity to you as the lender, and then basically you would say that I've lent money to the business and I'm entitled to a deduction for it. Reducing the home ownership subsidy. As the suburbs spread, so does problems with the transportation infrastructure. It started, we had a southeast expressway, but it certainly wasn't going to affect anybody else. Now the Southeast Expressway problem has spread to the Mass Pike. It has spread to the Big Dig going to the north. We're in a real mess, and so maybe this is a factor, maybe it isn't a factor, but the home ownership subsidy, which has fueled the growth of suburbia for the last 70 years, is now being cut back. We talked before about home mortgage deduction, reduction to $750,000 of indebtedness. We've talked about the reduction in real estate taxes and income deduction to $10,000. Eliminating Uncle Sam as a co-insurer.
Morris, question on your left.
Oh, yes.
Morris, the mortgage interest deduction of the first $750,000 of debt, could that aggregate, just for example, a $600,000 first and a $30,000 second, still be within that, so you could deduct the
Sure.
home equity? It's just the whole net.
Sure. In fact, what some people do when they want to bootstrap is they will take out both a first mortgage and a home equity line when they're purchasing a
So
home.
you can aggregate to the.
Oh, you can aggregate. You can aggregate. It doesn't matter how many mortgages. It just matters that the money is being used for a specific purpose. Good question. Eliminating.
Another question.
Yes.
So related to that, Morris, is the question, if you have a $1 million mortgage,
Yes.
since you're over $750,000, does that mean you get no interest deduction, or you get the interest on the first $750, or 3/4 of your interest payment gets deducted, and it's just the remaining quarter that took you over $750 in principal, it's not deducted?
Yes, yes, and yes. Let me just explain a little bit. I think I'm going to go over a little bit, but
That's
is that okay? Okay, and Jason has an issue. Let me talk to Paul first. First, welcome, Paul. Haven't
Thank
seen
you.
you in a while. You look great.
Thanks so much.
You're welcome. Paul's asking two questions. Let me spread them apart. Question number one. When I purchased my home, I got myself a $1 million mortgage. Okay, I bought my home in Wellesley or in Weston. I got myself a $1 million mortgage. Under the new tax law, can I still deduct all of the interest, or can I only deduct part of the interest? And the answer is you can deduct all the interest as long as you purchased your home before a specific date. In other words, if you are grandfathered in. However, if you purchase a home today under the new law and you are not grandfathered in, yes, you would have to prorate. Exactly how would depend on the facts of each situation. Somebody else have a question?
Jason, you still want to say something?
Okay.
One more, Jason wants to speak. And,
Yes, Anya.
Yeah, but it's a related question, but it's still, even if you're grandfathered in, you're still capped by the ceiling of 10,000, aren't you? So being grandfathered in isn't really gonna help you.
Yeah,
That's
right.
taxes.
For real estate and income taxes,
Yeah,
even if you bought your home 20 years ago, if your real estate taxes are $8,000 and your Massachusetts income taxes are $6,000, 8 and 6 are 14, you're limited to $10,000 of
so there's no being
deduction.
grandfathered in.
So what is grandfathered in is only the cap on the interest deduction. Good question. Let me just spend another minute here on the reduction in quality service, because Yale's going to cover that last point about the tax credits. The Taxpayer Bill of Rights, which is provided by the, Debbie, can you get me a glass of water? Okay. The Taxpayer Bill of Rights says that taxpayers have the right to receive prompt, courteous, professional assistance. How are they doing? The other obligation, we shouldn't laugh. We shouldn't laugh. I apologize, Paul, but...
No, I think I know the answer of how they're doing, that's what I was...
Okay, well, I'll tell you how we're doing. The other objective that the IRS has, if I could squeeze it down to two objectives, in addition to prompt, courteous, and professional assistance, they have an obligation to collect the tax. At the present time, the tax gap hovers around $1.06 after enforcement. a country that is unable to collect $1.06 in taxes, I would say, is in trouble.
Just to put numbers on that, if the tax gap is about $500 billion and the tax being collected is $2.5 trillion, that's about what we're talking about. Big numbers, but that's the fraction. Yeah.
Okay? And you have to ask, why is Joe Q. Public going to want to report his income if he knows that his friends are not reporting their income? $1.06. Now let's focus just for a second about IRS services. This is an example that comes from an actual IRS notice. Don't panic. Don't call. Read the letter and respond in writing. What happens if you're not a lawyer, if you're not an accountant, if you got a C or a D in English and you've been out of school for 25 years? IRS audits. They used to audit the full return. Now they audit a specific issue, and they call it a day. IRS appeals. They used to be face-to-face. They used to be give and take. It was a negotiation. No longer. Now it's all done by paperwork. You basically file a protest letter. It's basically a brief. And if new evidence is called for, you actually start to talk about the merits of the case and you have new evidence that wasn't previously presented. Well, we handle appeals. We can't look at the new evidence. The new evidence has to go back to the examining IRS agent. Cases are delayed, and it's been my experience that when we have a case in our files, every month or so, we have to do another 3/4 of an hour or an hour and a half's work just to maintain the case. And clients have to pay for it with professional fees. Private debt collection. The IRS tries to sugarcoat what private debt collection is about, but it admits that lack of resources is an important issue. Massachusetts does it too. I had a situation earlier this week where a client called up and says, I got a call from a debt collector. It turned out to be from Massachusetts. And I spoke to Bob, and Bob says, I can't talk to you. I'll bring you to my supervisor. So I speak to the supervisor, and the supervisor says, I can't stop collection. So what we have in the office, and when we leave here, what we're going to do is, before the end of the day, is we're going to be sending a letter to Dana Ackerman, who is our Massachusetts tax ombudswoman, and we're going to say, we have a claim for refund, and you have no right to be bothering the taxpayer. And what we want you to do is to process our claim for refund and hold off on collection activity until the refund has been properly processed. Private debt collection. So that's where we are. It's not a very pretty picture. As tax practitioners, we're not very thrilled about it because we do not work well unless the IRS also works well. And the IRS is not working well today. With that, cheerful news, and we'll turn it back over to Yale.
Thank you, Morris. I tend to speak fast when I am nervous. If you hear me speaking very fast like this, raise your hand and tell me to slow down. Thank you. The laughs are because some of you have heard me do this before. I appreciate the nod. Okay. Let me begin by orienting you on the Tax Cuts and Jobs Act, the tax reform legislation that President Trump signed into law last December of 2017. The law is structured as, in some ways, replacing old law in the Internal Revenue Code, Title 26 of the United States Code, but in other cases, not replacing it, and instead making an exceptional overlay for a period of a few taxable years. A typical example of the latter approach is Code Section 1. I don't encourage anyone here to read the entire Internal Revenue Code at any point in your life. I've not done it myself, and I've been doing tax law for several years. But I've read a fair portion of it, and as many of you know, Code Section 1 is the individual tax rates for the various types of individual filers, as well as fiduciary filers. And Section 1A, the first subsection, subsection 1A, is the individual rates for, I believe, married filing jointly taxpayers. And one of the reasons why I don't encourage reading the Internal Revenue Code, aside from it being long and somewhat dry, is that you won't necessarily know from reading it what you need to do as a practical matter. And the reason for this is that the rates in Code Section 1A are not the current rates. They're not the current rates because those tax bracket cutoffs have changed year over year based on statutory inflation adjustments that the IRS publishes in November of the year preceding the taxable year for which those new tax bracket rates take effect. And in November of 2017, as it always does, for every taxable year of the last 20, the IRS published a revenue procedure, 2017-53 or 55, I forget the number, and they said, next year, the taxable rates will be X, Y, and Z. And of course, we all know that in December, a month later, tax reform blew all that up, and it doesn't mean anything anymore. So Section 1A is meaningless over the inflation adjustment revenue procedure, which in turn is meaningless because of tax reform. So now you have to know what you're supposed to look at in order to get the tax amounts right. Of course, as a practical matter, most of us use tax preparation software, which circles back to the instructions that the Internal Revenue Service puts out on its website for the tax return in question. So there will certainly be some confusion come tax time next February through April, hopefully less, though, than there might otherwise be. So comes along Code Section 1J, J as in jelly. And Section 1J says, oh, by the way, everything we said in Code Section 1A through 1E is wrong. So the question then is, why not simply repeal Section 1A through E and put the new tax rates in there? And the answer is, for political reasons, which I don't need to discuss with you, the statute was amended in a very clumsy way. It was amended in a clumsy way by saying that for taxable years beginning after December 31, 2017, and ending before January 1, 2026, or to translate into plain language, for the 8 taxable years of 2018 through 2025, the following taxable brackets will apply instead. And you see on your screen the tax rate brackets for married filing jointly, subject to the inflation adjustments for years after 2018, so that after accounting for the standard deduction where that deduction applies, the first dollar after that is taxed at 10% of taxable income. That's the top right of your screen. And that tax 10% rate goes up to $19,050, at which point the next tax bracket is 12%, then going down the right-hand column, 22%, 24%, 32%, 35%, and finally, income over $600,000 per year in 2018 for a married couple filing jointly is taxed at 37%, which is a reduction in rate over the prior maximum taxable rate of 39.6%. And that can be found in 1J1 of the code. Tax rates for head of household are different. You have, I believe, access to the PowerPoint slides either in the printed materials or there's a link from the printed materials to our website where these PowerPoints are posted. I'm not going to go over the numbers in detail. You can get any online calculator by Googling it. Will tell you where you need to be if you have a certain income under these taxable rates. These are the single rates, and there the maximum rate kicks in at $500,000 of income, same as head of household. And finally, for married filing separately, the maximum rate kicks in at $300,000, which is half of the $600,000 for married filing jointly. This means that if a husband earns $300,000 and a wife separately earns $300,000, their total is $600,000, and there is no particular benefit or detriment. It may have an impact on the lower tax rates, but basically, in that situation, the choice of married filing separately or married filing jointly would be immaterial from a pure tax rate bracket perspective, and that decision would need to be made on the basis of other considerations, such as, does the couple wish to be jointly and separately liable for the taxes under the Code Section 6013, etc., etc. Finally, for estates and trusts, the tax rate brackets are much, how do I say this? Your maximum rate of 37% kicks in at $12,500 of income. This is very similar to the law as it once was under the pre-Tax Cuts and Jobs Act legislation. There, based on inflation adjustments, it was $12,400, and so they just rounded up another $100. And so there's really no significant change in the tax rates there. And this means that the estate planning considerations that previously existed still exist, insofar as if you are a tax consultant for an estate and your estate has beneficiaries or a trust has beneficiaries, it is desirable to carry out income, distributable net income, to the beneficiaries so that the beneficiaries are taxed at their personal income tax brackets, which are much more friendly, and there they will be paying less than 37% on the first few $100,000 of income. So therefore, there is that incentive still in place. Go ahead.
Yeah, do you have to do that by year end, or is there a period after the year end?
65 days.
Thank you, Morris. I agree with that. There is a special code section. It's in the 600s, which is subchapter J, which says you have 65 days after the close of the taxable year, which translates, depending on whether February has 28 or 29 days, to either March 4 or March 5, but you don't wait till the last day.
But not for state.
Correct, I believe as well.
But not for state. It's
Yeah.
only at the federal level.
Yes. The standard deduction is now $12,000 for single filers, $18,000 for head of household, $24,000 for married filing jointly. These are 2018 numbers subject to inflation adjustments for following years. Again, this is part of the overlay, and again, this is about double what it used to be, so that it will no longer be necessary or desirable for many taxpayers to itemize. A lot more will be claiming the standard deduction. The personal exemption is repealed for U.S. taxpayers. For international taxpayers who have U.S. effectively connected income and can claim the personal exemption under Section 864, I think. I believe, but I'm not certain because I haven't seen any guidance from the government on this, but reading the statute in plain language, I believe that those people still do get the personal exemption of about $4,050. I sincerely hope that the IRS will publish specific guidance on this point because one of our clients has a need to know on this issue. Child tax credit is modified from a maximum of $1,000, now it's $2,000 per qualifying child, refundable up to $1,400. There are changes to the itemized deductions. Morris already covered some of these, and to keep ourselves on track for time, I'm going to skip this slide.
Yeah.
Yes, go ahead.
What about taxation of trusts?
Could you clarify the question? What are you asking about taxation of trusts?
The rate for taxation of trusts, has that changed also?
So the question was, has the rate changed for taxation of trusts? So the section 1E, which was now overlaid by section 1J5, is the tax rate for taxation of estates and trusts. And that is both true for both estates and trusts. I mentioned estates before. It's true for trusts as well. And so there is a distinction in the code between a simple trust and a complex trust. And you'll find that distinction again in subchapter J. There's also an exemption for the first few $100s of income. I forget whether it's the 100 for estates, 300 for simple trusts, 600 for complex trust. I may be mixing up the numbers, but you'll find it in section 642 or 43, and that remains in place. So the first dollar after that is taxed at the rates on the table, on the slide that you saw here. I'll just scroll back to it. This slide here. Go ahead.
You know, it's a bit of an arcane question, but for a special needs trust, is there any sort of exemption, or does all that income that you can't pass out necessarily get taxed at the trust rate?
I don't know. Morris, do you know?
No, I don't.
Okay. Ask us at the break to look it up. I don't know the answer. Another hand, or move on? Move on. The moving expense deduction is repealed. The deduction for wagering losses and expenses, that's the change, cannot exceed gambling winnings under Code Section 165D. Individual mandate we've talked about already. Alimony and inclusion of alimony is changed as well. Cheryl Morse will talk about that in about 5 minutes, so I'm going to defer to her. Changes in the alternative minimum tax rates, estate and gift tax. So let me just talk about that briefly. The gift tax is still in place. As Attorney Leo Cushing pointed out to me at Boston University, the gift tax is not only a backstop to the estate tax, it's also a backstop to the income tax. So with the income tax still in place, it makes sense to have gift tax as well. And the exclusion of $14,500 from the gift tax is still good. So if you want to make a gift to a child to help him buy a home or whatever it might be, you can still do that up to $14,500 per year. Anything more than that, you must report on a Form 709 gift tax return, but your lifetime exclusion will eat that up pretty quickly because lifetime exclusion is now more than $11 million per individual or $22 million per couple. Time to contest.
Which means that as a practical matter, you file a gift tax return, but you generally aren't going to be paying a gift tax on the transfer.
Yes. Another distinction is that the gift tax is tax exclusive, I believe, but the estate tax is tax inclusive. I may be reversing that, but that the gift tax is like that. Time to contest an IRS levy is extended to 2 years from 9 months. I've never had this issue come up, but if it does, you may have more time. And what did I write in the little bottom slide? Oh yes, 1031 like-kind exchanges. The rules on what can be used in a like-kind exchange is now restricted to real estate that is not held primarily for sale.
And the real estate has to be located in the United States.
Thank you, Morris. I forgot to put that on the slide. It must be located in the United States. The IRS published withholding guidance for the benefit of payroll service providers and others who need to change the withholding on individual taxpayers. By now, anybody here who is a W-2 employee has seen your withholding change, probably go down. And if it's gone down too much or not enough, you might want to come to your HR people and say, could we take a closer look at this? The IRS has a withholding calculator on the website. The IRS has encouraged through their press releases that people do a withholding checkup. And you are advised, and you may advise your clients, to take a look at that before the end of the year so that you're not looking at a large refund or a large amount of tax due come next February or April. This is always good advice, but particularly so when the tax rates have changed so substantially. Section 965, the transition tax on foreign earnings. I had to put this somewhere, so I put it here. I had to put it somewhere because the large corporations are in the process of paying tax over an elective 8-year period for their post-1986 foreign earnings that were held in offshore subsidiaries, and Now that money can be brought back to the United States. It does not need to be brought back to the United States, but the point is, under old law, the money was not taxed until it was brought back to the United States. And so we had billions, maybe trillions of dollars parked offshore, and now that money is, so to speak, freed up. But there's a whole process in terms of how that money is to be calculated and taxed. The statute itself runs for 10 printed pages. Like, I haven't read the Internal Revenue Code entirely. I haven't read that statute in its entirety. But the basic points are here. And that is that for cash and cash equivalents, the rate is 15.5% of the cash held offshore. And for non-liquid assets, it's 8%. And again, there's this elective 8-year period so that the government will keep getting money until 8 years from now. Go ahead.
For mass purposes, mass does not address 965 for individual tax returns for individuals because we're on the 2005 code. So there's a question as to how mass is going to address it. For corporations, mass does not address it at all, and they're following current code. I'm just pointing that out.
I'm glad you asked that question, Jason, or made that observation, because I just yesterday printed out an article published on the internet by one of our competitors, and that article says that Governor Baker and his advisory team have recently put out a proposal as to how Massachusetts will tax this income. Massachusetts definitely will tax it. Yeah, go ahead.
If it's paid.
Oh, well, yes. Can you clarify that, please?
This is a deemed transaction that
Right.
people can elect to include, have to elect to include in their income. But it's a cash basis taxpayer, so until Mass addresses changes in its law, I don't know if it's taxed.
Well, individuals are cash basis taxpayers. Some of these
Individuals are under 2005 code.
right.
So therefore, the individuals are not impacted with this provision
Okay.
at this point in time.
Yeah, Jay, let me just clarify. This is, we hadn't intended to get into it, but it's really very simple. Especially if you're looking at it from a 20,000-foot perspective. Massachusetts uses the federal code as one of the foundations for its own tax system. It's not a piggyback system, it's part of the foundation of their tax system. Now, when it comes to corporate income taxes, they follow the United States Code as in existence today. However, when Massachusetts applies the federal code to individuals, every few years, every dozen years or so, they re-adopt the code. The last time the code was adopted, the federal code was adopted for individuals, I believe was in 2005?
January 1, 2005.
Okay. I was alive then, but I don't quite remember that. Maybe it wasn't such an important thing in my day that day. I was probably off because it was vacation. It was New Year's Day, right? But the point is that you can have a difference between federal and you can have and state. And what Jason is saying is that you always have to be cautious. And whenever you have a new set of laws, a new set of rules that apply for federal purposes, you cannot necessarily assume that those same rules are going to apply at the state level. And in this particular case, they probably don't, because you can have, in order to be required to report this income, you have to be, I believe, somebody who has at least a 10% interest in a foreign entity. If you're an individual or if you're a trust, you may be able to do that, but in such cases, you'd actually have to bring the money on board. But this is for individual purposes, but if you're a corporation, you already have to report it.
That's it for, go ahead.
Going back to the repatriation of earnings, and the cash being taxed at the 15.5%, the non-liquid assets I'm a little curious about at an 8% rate. So is that if you have intellectual property, for example, that's overseas, that you decide to transfer the ownership of that back to the U.S.? Is that the nature of what would be considered a repatriated non-liquid asset, or am I totally wrong?
I don't know. The best I can say is that the IRS has already published 3 notices on its website, which you have in front of you. You may want to write these down if you want to look that up after our presentation. I don't know how they define those things. There are a lot of definitional issues. Go ahead.
If, let's assume $100,000, if you can only repatriate because you only have $50,000 in cash, the balance of the $50,000 you can take back into your, you can take that back in, adds to basis, but you pay an 8% tax on it.
I have to cut this short because we're running short on our schedule, and Cheryl has about 25 minutes to go till our first break. Cheryl, please come up. This is Cheryl Morse, who will be presenting to us on alimony for income taxes under the reform law. I don't have to tell you that this is a very important issue for a lot of people, and Cheryl will explain why that is. Go ahead, Cheryl.
Thank you, Gail.
Thank you, Cheryl.
Thank you, Morris. Thank you to M. Robinson and Company, Debbie in particular, for first inviting me. And there is some information in your packets or available online, because initially Yale had asked me to discuss divorce, and I have written a 4-hour presentation on divorce and alimony, and I don't think you want to be here till about midnight, so I am giving you a very quick synopsis of that. He had also asked me to discuss issues regarding special needs. I've just written a 25-page booklet regarding special needs. And as to your question, was it your question about special needs trusts? Someone's question.
Over the front of the
Special needs trust, they have not, there have been no changes to the special needs trust under the Tax Reform Act. So stays as is, no change to any of that.
No, but, so there is no extension for the payment of it? In other words, if a special needs trust realizes a lot of income that it can't use for its special needs, it's going to get taxed on it?
Correct. Correct.
That's what I thought.
Yes. Yes, so I did put in your information just a very, very brief outline of the items that I address in that booklet. So it's not really giving you all the information that you might need, but is kind of food for thought and points you in a direction where you might need to think a little bit more about something in a way that you haven't in the past. So as far as divorce considerations go and the changes to the law, the population itself that we deal with. I know Debbie was astounded when I first mentioned this the other day, that we have 1 divorce every 13 seconds. That seems incredible to me. And with the divorce rate still declining, the marriage rate still declining. We have over 7 million households that we have cohabitants, and about 40% of those have children. So while this is really discussing divorce per se, there are still property settlements and who gets to claim the child issues in households where there has never been any formality of the relationship. So it's not just necessarily divorce that we need to address. The Tax Cuts and Jobs Act, what did it do specifically that I'm going to talk about? Well, the personal exemption. I think Yale might have mentioned it earlier, I might have missed it, about the personal exemption being eliminated, and that we're now going to have some alimony not be taxable and some alimony not be deductible. You know, there's always that give and take, kind of a yin and yang, as far as if there's a deduction, then there's usually tax somewhere else to benefit that or offset that, although that deduction and taxability doesn't actually offset. Because if you think about the way that alimony works, you've got a higher income person at a higher tax rate that is having a deduction, and then that income is moving to somebody with lower income, lower tax rate, having that taxable income. So it's being taxed at a lower rate. That's going to affect settlements too, and we'll see that, and we'll talk about that near the very end. So let's back up to the personal exemption. That personal exemption elimination actually sunsets. Sunsets December 31st, 2025. So as I know Gail mentioned about overlays in the law. Throughout the law, the personal exemption is still referred to. For example, the 8332. That has not been revised since 2010 when they added Part 3 for the revocation of the 8332. And the title of that form is Release of Personal Exemption. Now, they may or may not revise the form, but I believe the form will still be necessary in order to claim a dependent. Because even though we're not getting the personal exemption anymore, all the benefits attendant with claiming that dependent are still intact. So dependency, we just can eliminate the word dependency exemption and just think of it as dependency, at least through 2025. So under 71A, 71A of the code is the part that talks about taxation of alimony and that qualified payments are taxable to the recipient. Under 71B, it defines what a qualified payment is, that it must be made in cash to or for the benefit of the recipient, and there are some other rules regarding that which we'll talk about, and whether or not they are rendered moot going forward. Along the lines with that, we have now taxable income. I know there have been a lot of jokes made about alimony being earned or hard-earned income, but for the purposes of IRA, it is considered earned income. What happens to that when it's not taxed anymore? IRA deduction? Absolutely not. So we've got more pieces to this puzzle that we're going to look at. And again, I mentioned taxation versus the other side. 215 talks about being able to take a deduction. Those qualified payments being made by the payor, they may take a deduction for them. Again, has to be made in cash to or for the benefit of the recipient. You must live apart. No War of the Roses, living in the same house. I actually had a client, a couple that divorced, could not afford to live apart, and they lived in the same house. And there was alimony, which could not be deducted and was not taxable because they lived in the same house. Okay? And they lived together until he died for years and years. One of the other stipulations regarding death. Alimony must state that it ends upon death in order to be considered alimony. And the instrument cannot say that this is not alimony. That written instrument, that's all part of whether or not someone can deduct and whether it's taxable. Okay. Now we have, yes ma'am?
No, don't answer this if you're on time.
No, that's okay, or if, go right ahead.
So if you have an alimony order, it is often coupled with life insurance requirements, so if the person dies, then the alimony, can get paid through some source. Is the life insurance that's payable as alimony a debt on the estate tax? Do you know?
That's an excellent question. The question was, if there's a life insurance requirement, as there often is, and the life insurance is considered basically a makeup in lieu of continued alimony, is that then considered to be considered an alimony payment? Is that what you're really asking? An alimony payment, and it is not.
And is it considered then a debt of the decedent for estate tax purposes?
You mean the payment of the life insurance proceeds themselves? No. No, but that's a great question. Thank you. And I haven't had that one before, so thank you. So the Tax Reforms and Jobs Act, what happens to alimony and the taxability and the deductibility? Well, we talked about the personal exemption sunsetting. and that's going to come back, the repeal of the personal exemption. There is no sunset provision here. So alimony will not be taxable and therefore also will not be deductible going forward. It's going forward. There is no sunset provision. So the Tax Cuts and Jobs Act does away with Section 71, talking about the taxability, and 71A and B, I mentioned the description of what is alimony, as well as 682, which deals with alimony trusts, which are a way to kind of escape that death clause and no lump sum payments, etc. So those are all overridden by the Tax Cuts and Jobs Act. Yes?
For the purpose of getting grandfathered in, is the date that counts the day the divorce was granted, or here in Massachusetts 90 days later when it became absolute? Meaning, do you have to be divorced by September 30th? Because then really it's only absolute, or 31st.
Excellent question, and you are one step ahead of me. So if you
Okay.
just sit tight for
The
1
reason
second,
I
and if I
have
don't
question
answer your...
because a friend of mine literally asked me this because she's in the process of getting
And
divorced
I
and trying
think-
to figure out how much time she has.
Exactly, and I think a lot of people, or a lot of our clients are in that situation right now. So what is the effective date of this taxability, deductibility? So if you sit tight and stay with me for another slide or two, and then if you have more, I will expound. All right, so right now, it applies to a divorce or separation instrument executed. So it's not saying the divorce is final necessarily. This separation instrument executed after 12/31/18. Agreements prior to 2019 are grandfathered, which means they will remain taxable and deductible even if there is a modification to that divorce. So you had your client who was receiving alimony and had been being taxed on it, and their ex-spouse was deducting it, and they had this 2017 divorce, which was then modified in 2019. That divorce document, it's grandfathered in with the taxability and the deductibility. Moving just a little bit further ahead on that, we've got an opt-in provision. So we've got people who are in the process right now. And for 2018 only, there is a choice. There is a choice, there is an opt-in provision. So the couples must agree whether or not, and that may be a problem, that's probably why they're divorcing as it is. So one more thing for them to agree on is how to treat that alimony. So the opt-in itself, we have to have a meeting of the minds. It has to be in writing, and both parties must sign it, or one party must also write a statement agreeing to the opt-in provision. And they don't have to specify that a certain dollar amount of the alimony is going to be taxable. They just have to specify, or not taxable, they just have to specify that they do want the alimony itself to be taxable or not. So, continuing, still with, is it Anna?
Anya.
Anya's question, those pre-2019 modified, still under prior law I mentioned, what about the people who are now, have maybe a temporary agreement? There's a temporary order, but their divorce is not going to be made final until 2019. So are they under the old law or the new law? And there's no specific regulation. However, if you look back to 1984, which was the last time there was a change in the taxability deductibility, 1984, the court cases by and large fell on if the temporary order was not changed in dollar amount or duration, then it was considered final, and in fact, the 2018 So what I'm saying is we have somebody 2018 and they're supposed to get $1,000 a month for the next 10 years. And that's the temporary order. They don't get divorced. It's not final. The hammer has not come down until 2019. If 2019, they take that agreement that they made in 2018 and they say, yes, let's make that permanent, then they're under 2018 law. If, however, that 2019, they say, you know, no, that's going to go on for 15 years, or we're going to change that dollar amount to $1,100. Now it's 2019 law. So as long as that temporary order stays in effect and is not changed in dollar amount or term, then that will fall under the prior law. So if your client is the person receiving the alimony, you may want her to drag her feet until 2019. You may want her to get a change, because then she'd be under 2019 law and not be taxed.
I mean, my question was slightly different because it was not about temporary order or not. My question was really more referring to what is the date that counts. Let's assume this is a settlement. Is it the day that the two parties sign a settlement agreement? Is it the date that the settlement agreement is turned, a divorce is granted? Or is it the date 90 days later where the divorce becomes absolute? So what you are saying is, assuming there are no changes between the separation agreement, the divorce being granted, and the divorce becoming absolute, they could at least sign the separation agreement on December 31st and would still be grandfathered in.
Correct.
As long as there are no changes.
Correct.
But they cannot make any changes.
Correct.
Okay.
And I know there are a number of blogs out there talking about exactly what you were saying. You know, if you live in Massachusetts, you don't have until the end of 2018. You need to get divorced by August 31st because you've got 90 days or 120 days, depending on whether the divorce is contested or not. So you needed to hurry up and get in and get divorced by that. But that's not necessarily true. If you have that meeting of the minds, whenever that meeting of the minds takes place.
But then the second part that you said about, it makes sense for the recipients to drag their feet.
Yes.
I happen to actually disagree with that perspective, because from what I hear, it's widely assumed that the judges will change their orders. Because, a long form takes tax into account.
Right.
So the judges are obviously obliged to consider tax.
There are a lot of...
Considering that what you were saying before, that, the tax burden is getting shifted from the lower tax bracket to the higher
Right.
tax bracket, there is overall less money available to share.
Correct.
So, it's really, my definition is that the recipient is really the one, and that's largely what I read everybody, this is really a terrible ruling ultimately for the recipients.
I would
Because
agree.
they will ultimately get less money, because the courts will very quickly adjust. They will take into account there's less money in total.
Well, you know what?
So
You're
this
finishing
is
my whole
actually-
thing for me,
Yeah,
so
Sorry.
so I can just sit down.
Sorry.
That's quite all right. But I do not disagree with you
Yeah.
and the whole problem with settlement, but we're like 5 steps ahead
Sorry.
now. That's quite all right. All right, we discussed earlier about Massachusetts law, and that Massachusetts is not the same as federal. And my colleagues at Department of Revenue, such as Dana, will quickly tell you we are not the same as federal. We are similar, or they are similar. So Massachusetts, what's this going to mean? Well, we still have our Schedule X, taxing alimony, and our Schedule Y, deducting alimony. Massachusetts isn't quick to change or follow, so we'll see. But right now, it stands. Now, we have Rhode Island, which is a piggyback state. So since they're a piggyback state, they're going to be following federal law. And I had looked at New York, New Jersey, North Carolina, about a handful of states that all are following federal or arguing with federal. So it's in a state of flux. But right now, remember, this does not sunset. So this is the law. And I always tell when I'm speaking that it is the law and it is permanent until it's not. Continuing on with some of the attendant pieces of alimony and fighting for alimony? Well, we can deduct our legal fees if they are for the production of taxable income. So if you've got your divorce and it's part of it is the fee to fight for the property settlement, and part of it is the fee to fight for the child support, and part of it is the fee to fight for alimony, and that alimony is taxable, then that part of the fee to generate taxable income would be deductible. Okay, well that's great, subject to 2%, and now we've got the higher standard deductions. So in reality, we're probably not having that many clients who are going to be deducting their legal fees if we had all that money before. I talked about the definition of alimony. Yep.
One question, what if there is a fight for alimony, but then it's lost, meaning there is no alimony granted?
That's
You
an
still had the legal fees, but you didn't get it.
But it wasn't for the production of taxable income. I realize you had the fight for it,
Yes, but you lost.
but you lost. So I believe no, but I'm not 100% that there is not some court case somewhere that argues that.
And alimony isn't taxable anymore, so what's the?
Well, that's it. So going forward, now, we're going to lose it if we don't have taxable income because it's for the production of taxable income. So we've lost our IRA deduction. We're going to lose the possibility of that deduction if it's not taxable. And at any rate, we're still looking at 2%, and we're looking at the higher standard deduction. So it's kind of a moot point. Continuing on with things that change with alimony, just not the taxability and the deductibility, but fallout from that. Fallout. Large payments. You must make similar payments in the first 3 years. The year 2 and 3 payment for alimony must not be substantially different than year 1. And year 3 may not be more than $15,000 different than year 1, or you're subject to recapture. Well, recapture about what? That's current or old law now. That's the way it has been. All right, so you just want to be done and over with. You've got the new girlfriend, you're getting married, you're moving on with your life. You just want to pay her off. If it's not past year 3, under old law, you're subject to recapture, which means all that alimony you deducted, you now have to put back into income. Well, if I'm not able to deduct my alimony, then I don't have to worry about recapture anymore. So this whole worry about a lump sum payment, difference, recapture of what? I had no deduction. So I'm not going to be dealing with recapture. If we're not defining alimony under Section 71, then maybe I don't have to make a cash payment. Maybe I can give my ex stock for alimony. Maybe I'll be able to give my ex life insurance for alimony. And it won't matter because it's not going to be taxable or deductible, just like a property settlement. Moving away from the alimony piece, and this isn't anything new, kind of a review about dependency and the family court versus tax court. We all have our clients, they come into us, they've just gotten divorced, and you ask them, so who has custody? We both do. It's joint. Okay, well, where did the child spend one night more than the other? It was exactly the same. Was it leap year? Because otherwise we have an odd number of days. So we have to get our clients to understand that it doesn't matter what family court says when we're sitting with them tax-wise. The tax court rule is who has physical custody, not legal custody. Where did that child spend one night more than the other? Now, I'm not saying that they can be in contempt of court, so they may have a qualified dependent that the court has said they must give to the other parent, but who has physical custody, and it makes a difference. There is a difference between whether someone is qualified to be my dependent or it's my turn to claim them, as we often have people who switch back and forth. And if they cannot agree, then we deal with the tiebreaker rules. Whoever makes the most money wins. And that's the tiebreaker rule. So what are the benefits for the custodial parent? They always get head of household status if they qualify in other ways. Giving away or letting someone have the child because it's their turn doesn't allow them that head of household status. The earned income credit still stays with the person with physical custody. And the dependent care credit and those DCBs. If you've got dad and child lives with mom, and dad is paying the daycare with his pre-tax dependent care benefits, they are going back into income for dad. Because he cannot, even if it is his turn to claim the child, take that dependent care benefit. What is the purpose of the dependent care benefit? It is to allow you to go to work. If you don't have the child in your home, you don't need to have a sitter watching that child for you to go to work. You are not entitled to that credit, and those DCBs have to go back into taxable income. The piece that gets waived with an 8332, if you are the custodial parent and you are giving the other parent either court-ordered or taking turns, whatever the case may be, that personal exemption, which is gone. The child tax credits always land on the tax return where the child landed. And then some of the education-related benefits. The student loan interest, again, you had to have paid it and be liable for it. Same thing with the tuition and fees deduction. But the education credits, those go wherever the child went, regardless of who paid for the college expense. They go with the child. Now, I'm talking about the custodial parent, and I'm talking about divorce in this situation. We have 7 million households with unmarried people, 40% of those with children. You can't have that cute little couple come in and sit down and they want you to do the best possible job, figure out how they're going to get the biggest refund, who claims the child, and divide these benefits. If they are living in the same house, they are both the custodial parents, and all of the benefits land on one return or the other. They cannot be divided unless they are not both living in the home. And the child tax credits have increased $2,000. That one that your clients call you at when you do the taxes and say, you forgot to claim one of my kids. It's no, they turned 17 and they're just not getting the child tax credit anymore. That refundable part is up to $1,040 and new with the Tax Cuts and Jobs Act. You must now have a social security number to take the child tax or the additional child tax credit. That is new. You used to be able to get it with an I-TIN or an A-TIN. You must have a social security number. However, not so for the new credit. There's a new non-refundable $500 credit for your dependents who don't fit in that under 17 category. Maybe your parents, whatever the case may be, and they don't have to have a social security number. That kind of slipped through the cracks. All right. The itemization rules, quick reminder, for some reason people can't seem to get their head around the part about head of household. Everybody knows if married filing separate, one spouse itemizes, the other one needs to. However, if we've got one that's filing as head of household and the other that's filing married filing separate, head of household itemizes, the married filing separate one needs to itemize. However, if the married filing separate one itemizes, head of household does not have to. Head of household can do whatever they want. Married filing separate has to do whatever their spouse or soon-to-be ex does. This is going to have a huge impact. It's impactful as it was, but now you might have somebody who has no mortgage, no taxes, whatever, a few $1,000s withheld, and now we've got a standard deduction of $12,000 or $18,000. $12,000 standard deduction, and I have to itemize. Well, I used to lose a few $1,000s. Now I'm losing $9,000 maybe. That's very impactful. And the last piece here is those settlement issues, deciding the value of a dependent. I've had clients call me from court. What is that personal exemption worth to me? Well, it depends on your tax bracket. It depends on whether you're subject to alt-min. Well, now there's none of that personal exemption piece, and for the most part, even the alt-min piece, pretty much gone. But we're looking not so much at the tax rate implication as far as dependents, tax rate implication as far as alimony goes, because you're going to have higher income spouses less willing to agree to a higher amount, knowing that they're not going to get a deduction for it. You're going to be dealing more with the credit piece of it. And there is big concern as far as the court and the court awards go regarding AGI and child support. Because you're going to have, let's be sexist and say dad, and dad with that higher income who's paying alimony but doesn't get to deduct the alimony. And now the court is looking at the formula and the disparity in income and his AGI and awarding higher child support. So there has to be more proactivity on the part of the attorneys and probably some changes to certainly Massachusetts and other states' formula as far as how they come to the agreement about child support. As far as alimony itself goes in that order, as Anya said, the courts have more leeway. It's a suggestion and a guideline. So there are going to be fewer and fewer judges that are going to be willing to accept. I know I was involved in a case where one party was willing to give up all of the husband's retirement if they got to keep the house. And it would have been a fair and equitable deal based on the equity in the house. And the judge would not agree because they still had 20 years to go until retirement. It's like, you don't know what the value of that retirement is going to be. And so the judge would not even rubber stamp that. So I think we're going to see a lot of impact, not just is it taxable or is it not deductible, but all the fallout from that. And my last piece is the conflict of interest. It is inherent when we deal with divorcing couples. And Circular 230 tells us we must keep a conflict of interest statement on file for 4 years after the conflict no longer exists, telling the parties that we are dealing with the other, even if they come to us together. So it's not just divorcing couples that we deal with. It can be married couples. It can be cohabitating couples. Conflict of interest will rear its head more often than you can imagine if you sit down to think about it. So I did put the letter of engagement in the handouts, your electronic handouts, that I use with my clients to let them know the implications, not just of joint and several tax liability should they decide to file jointly, but 2 years down the road when they've moved on with their lives and they get a letter from IRS, I'm going to need powers of attorney from both of them, etc. And so I think that's all I have for this afternoon. Thank you for your time. Feel free to reach out and email me at any point in time. Glad to answer questions.
Okay, I'm going to change that. No questions now. We're on the time schedule, but please approach Cheryl during the break and ask her whatever's on your mind, and we'll meet again in 15 minutes.
Thank you, Dale.
Who is a certified financial planner with Modera Wealth Management, and he will be speaking to us about Tax Cuts and Jobs Act 2017, implications for investors. Michael, please come forward, and we'd like to hear what you have to say.
Thanks, Yale. So good afternoon, everyone. See if I can figure this out. Am I going to the right or the left to move this up?
That's the wrong way. Try again.
There we go. Okay. So Debbie and Morris were nice enough to invite me to come to speak to you all about the tax management issues around clients' investment portfolios, and particularly some of the issues that are some of the investment issues that are impacted by the new tax laws. To a certain extent, the impact is as much a set of close calls in terms of what some of the proposed changes were when the tax law was in conference and committee that fortunately did not get implemented, but there are still some changes that were impactful. So I'll talk about those. And I also thought it would be helpful, just to, since it's not a subject matter that all of you probably deal with on a fairly regular basis, I thought it would be helpful to walk you through our thought process in terms of ways in which you can manage a client's investment portfolio in a tax-efficient manner. As Yale mentioned, I work for a firm called Modera Wealth Management, which is here in Boston. We're in Back Bay. And we provide basically comprehensive wealth management to individuals. I work specifically primarily with a lot of corporate executives. And so I spend a lot of my time advising my clients about equity compensation, incentive stock options, restricted stock issues and things like that. But I also have a master's degree in tax in addition to my CFP, so I have a slightly different perspective on what we do for clients than many of my colleagues do. My objective today is really to review the tax management of investment portfolios and the challenges and opportunities presented by the new changes in the tax law. And also to help you guys really identify for your clients where there are potential areas of improvement in the tax treatment of their portfolio. So I'll highlight some areas that when you are preparing a tax return and you see something, maybe it'll set off some alarm bells or raise awareness for you to help address that with your clients, or at least bringing it up to them. How I'm going to go about doing that is really reviewing the changes to the laws that are relevant and sharing our thoughts on the best practices in terms of how we construct investment portfolios and really just the X's and O's, basic blocking and tackling. I don't think it makes sense to get into anything that's too advanced, but of course if you have any questions as I go through my material, feel free to raise your hand. So in terms of the changes in the tax laws, a lot of these have been discussed already, so I'm not going to bludgeon them to death. But the changes as it relates to investments really focus on the individual investment income tax rules. As was mentioned earlier, the changes in the standard deduction, the reductions in a lot of the itemized deduction areas such as state and local income taxes, the lowering of individual income tax brackets, the increase in the maximum, and this is a little different, but there's been a slight increase in the maximum deductible annual amount of charitable contributions from 50% to 60%, which is materially, a material improvement, particularly for higher income individuals. The doubling of the estate tax and gift tax exemptions is material. I'm not going to focus on it too much now, but one of the things we always tell our clients is, yes, the estate tax exemption has doubled, but it hasn't doubled in Massachusetts. And so best practices really still apply in terms of using credit shelter trusts and other strategies to make sure that individuals are maximizing the amount of exemption that they're receiving. The other thing that's not listed here is the increase in AMT exemption phase-outs can be material for investors, primarily for folks who have incentive stock options. So as you may or may not be aware, when you exercise an incentive stock option, the differential between the exercise price and the value of the security is actually an AMT preference item, and that has historically caught a lot of people up and basically has eliminated a lot of the value of using incentive stock options. So that has helped the increase in the AMT phase-outs, or the increase in the AMT exemptions. In terms of the near misses, there was a lot on my part of the industry. There was a lot of discussion kind of at the end of last year about the various things that they were talking about getting rid of. Fortunately, they haven't gotten rid of many things. The capital gain rates have remained the same. So as you may or may not know, it's 0% for folks that are in the 10 or 15% marginal tax bracket. 15% for folks that are in brackets below the top marginal rate, and then for folks in the top marginal rate, it's 20%. One little wrinkle is that the rates for capital gains used to match up perfectly with the rates for ordinary income taxes. So I mentioned the fact that if you're in the 0 or 15% tax bracket, your capital gain rate is 0. That used to be the case in 2017. Now that they've changed the brackets, there's a slight inconsistency between those rates. But at the end of the day, basically, the capital gains rates that apply to individual investors are the same now as they would have been in 2017. So there haven't really been any material changes there. One thing that has really become much more important and relevant for folks that used to be somewhat nuanced is the retention of the qualified charitable distributions from IRAs. So as many of you are, I'm sure, are aware, if you're over the age of 70 and a half, you are forced to take a distribution from your IRA. That distribution is, in your traditional IRA, is taxed as ordinary income. You're actually allowed to directly donate that money from your IRA directly to a charitable organization, and it doesn't come through as ordinary income. So I'll get into a little bit of how that's really something we talk about with pretty much every client now that's over 70 and a half, whereas it really wasn't something that was particularly advantageous for most people before. A couple other changes that didn't come to fruition is they talked about getting rid of the deductibility of contributions to employer retirement plans like 401ks. They quickly realized that was a losing political position, since that was really something that affected a lot of middle income individuals, so they retained the deductibility of contributions. And there was a lot of talk about getting, actually towards the last minute of the passing of tax law, there was a lot of talk about changing tax lot accounting for investment assets and forcing people to use FIFO, so first in, first out. So if you have an investment portfolio and you purchase a security in 2005 and you also purchase the same security in 2015, they were very close to forcing you to sell the oldest security, which is probably going to have the largest capital gain. They didn't get rid of that. So as I mentioned, a lot of the changes that have come about in the Tax Cuts and Jobs Act are really not hugely impactful. Most of the stuff that would have been impactful never got implemented. So that's the really good news. Let's fast forward here a little bit. So in terms of managing portfolios in a tax efficient manner, we have a couple different ways that we look at it. The first thing we do is we think about the portfolio strategy that a client is pursuing and how you can structure that portfolio strategy in a tax efficient manner. And the second layer, which we think about, is outside of the portfolio, what can you do to further minimize the taxation of the investment assets? In terms of that first perspective of structuring a portfolio in a tax efficient manner, the first step is really thinking about asset location. And the general rule of thumb with with an investment portfolio is to make sure that you're holding your least tax efficient assets inside your tax sheltered accounts like IRAs and 401ks and 403bs, and your least tax efficient investment vehicle in your least tax efficient investment vehicle is going to go in your qualified plans, and your most tax efficient investment vehicle is going to go in your taxable accounts. That sounds pretty obvious, but I would say the 80% of new clients that we work with, and even prospects, when we look at their investment portfolio, that's not being implemented and utilized. So I thought I would go through that quickly, how that works and the advantages of doing that in terms of tax savings. So in terms of using an asset location strategy, the first step is when we construct a portfolio for a client, we identify, how much risk do they need in the portfolio to achieve their goals, and what's the appropriate investment strategy to pursue those goals. Every investment strategy is going to, for most investors, is going to involve some combination of a variety of different assets for diversification purposes. You don't want to put all of your investment assets in one basket. So most people don't invest all of their savings in Tesla stock. That'd be pretty irresponsible and highly risky. They're probably going to have a combination of stocks and bonds and maybe some other types of alternative assets. We look at all of those asset classes and we simply list them in order of tax efficiency from least tax efficient, from most tax efficient to least tax efficient. And I have this our thoughts about this up on the slide. So for example, in terms of least tax efficient investment assets are taxable bonds, right? So bond investments pay interest. That interest is paid typically semi-annually, and that interest is ordinary income to the investor. Conversely, The most tax efficient investment would be something like a tax exempt municipal bond issued in a state, the state of residence of the investor. So for example, if you're a Mass resident, the most tax efficient investment you can possibly own is a Massachusetts municipal bond issued by the city of Boston or another municipality. And there's everything else is in the middle. One of the other things I'll point out that maybe is not obvious is that when you're looking at equity investments, something like a small cap equity investment is going to be typically be more tax efficient than a large cap equity stock investment. And the reason for that is small cap stocks, small developing companies, typically don't pay out their dividends to shareholders. They typically take their profits and reinvest them in the business. And so when you look at the actual tax payout of a small cap, small company stock, it's typically going to be materially less than what you would receive in payouts, taxable payouts from a large cap stock. So it is not just a matter of segregating your stocks and your bonds. It's looking at the actual types of investments that are within that asset class to figure out, where does it fall on this paradigm of tax efficiency. Once you've thought through that process, the next step is to then figure out, which bucket do I place this asset in? Do I place my taxable municipal bonds in my IRA account, or do I put them in my taxable account? Obviously, you want to put those in your taxable account because you're not going to generate any taxable income. In really high tax investments like high yield corporate bonds that pay large interest payments, you want to shelter in your IRA account. And we've run some numbers just to give you an example of how this works and the amount of savings that you could generate by utilizing a strategy like this. So we have two scenarios. Scenario one is just a base case. Client's investor, an individual's investing in a portfolio of 50% stocks and 50% bonds, and they're applying that throughout their various accounts, their brokerage accounts, their IRA accounts, their employer retirement plans, etc. In the second scenario is somebody that has that same asset location, but is has the same asset allocation, but is applying an asset location strategy within that. So they're purposely putting their bonds in tax sheltered assets and their equities and more tax efficient investments in their brokerage accounts. Using this just simple analysis, you'll see, I'm not sure how well you can read this, but it's in the electronic presentation that is available to you. In scenario one, we have a taxable bond fund in our taxable account, probably less than ideal. That bond fund is going to pay, say, $25,000 of investment income, which is going to give us $525,000 at the end of the year. If we assume that account is fully liquidated at the end of the year, we're going to receive dividends we're going to have $25,000 in dividends, which is going to give us a $525,000 end of year account value. Those dividends are going to be taxed at your ordinary income rate of $9,250, which is going to give you an ending balance of $515,750 in the taxable account. And then in your tax deferred account, you have $500,000 of an equity fund. You're going to presumably would have $50,000 of dividends and capital gains for an ending balance of $550. Remember, as those dividends and gains are earned, they're not taxable to the investor because they're in the tax sheltered account, leaving an ending balance of $550,000. The total ending balance of those two accounts at the end of the year is going to be about $1,065,000. But then, of course, when you take the money out of the IRA, you're going to have to pay tax at your ordinary income rate, which gives you a net balance using this scenario of $862,250. Then conversely, I won't go through the same the detailed mathematics, but if you place all of your tax efficient assets in your taxable account and your less tax efficient assets in your tax sheltered account, and you do the same mathematics, you end up with a slightly higher balance And in this scenario, we're saving the client, this strategy would save the client $9,000 in tax, in actual income tax, and that's on an annual basis. This isn't something that we present to clients. Clients tend to think of their net investment return just in terms of their gross, return. They're not getting this reported on any performance reports. But over time, this has a huge impact on your ability to accumulate investment assets over time. And so it's something that's really critical, and it's something that we just don't see implemented as broadly as we would expect. And it's really a low-hanging fruit to make sure that when you're making investment decisions or you're structuring an investment portfolio, that you're doing it in a way that is going to minimize taxes and maximize after-tax return. In terms of how you would actually do this, I have a slide here that shows kind of a more granular application of this kind of an idea. So on the left side, we have the asset classes, U.S. bonds, inflation-protected bonds, high-yield bonds, emerging market bonds, a variety of asset classes. So these are your your different asset classes with differing levels of tax efficiency. And then you have your different accounts. You have your qualified account, which is a tax-sheltered investment asset, and then your taxable account, which is a traditional brokerage account. And then you have your individual investment selections. So it's not just you're investing in bonds, right? Are you investing in bonds through a mutual fund? Are you investing in bonds through an ETF? And if what specific types of investments, bond investments, are you choosing? Are you choosing municipal bonds, or are you choosing traditional corporate bonds? And how you apply the various types of investment vehicles within the various accounts has a huge impact as well. So something like an exchange-traded fund may generate less of a return than a mutual fund over time, but an exchange-traded fund is a far more tax-efficient investment vehicle because ETFs generally don't have investors coming in and out of them, and it's not forcing the fund to pay out income to the investor. So ETFs, even if they're generating a little bit less of a return, expected return over time, it may be a more appropriate investment within that specific investment asset class for the individual if the individual can only invest in a taxable account. So it's really three different levels of thought process that really you need to go through when you're thinking about how you actually not only build an investment strategy, but how you implement it at the ground level. Moving on in terms of I'll stop there. Any questions on that? I know I kind of ran through that pretty quickly. Yes?
Do you allow the client to participate in determining how the investments are made? Or do most of your clients just say, leave me out of it, I want to go to the beach, use your own judgment?
So yes, we absolutely. So my firm, we are a registered investment advisor, which means our job is to advise the client, and the client's input absolutely has to be part of that conversation. We don't feel it's very healthy to just have clients completely disconnected from the investment decisions that they're ultimately making. Our perspective is that they're looking for us for our professional advice, but that doesn't mean we have to tell them what to do. I think it needs to be a very collaborative thing.
What is the minimum amount of money to invest that would be considered worthwhile for a client referral?
For my firm, our minimum is $2 million.
Pardon?
$2 million for my firm. Yep. But that most individuals can find a good investment professional that has lower investment minimum requirements. Typically, anyone that has an excess of $500,000 can get pretty good advice. We tend to work with a little bit higher net worth clientele. I specifically tend to work really with business executives, so I tend to work with a very different type of client and a very different set of needs. But I think for us it's $2 million. Any other questions? Okay. So let me go on. So outside of the actual structure of an investment portfolio and how to do that in a tax efficient manner, I wanted to just talk a little bit about, and I know my time's a little short, about how do you actually, when you think about distributing money from your investment assets and your investment accounts, how do you do it in a tax efficient manner? What are the opportunities available to you? As I mentioned, a huge issue now for individuals is the inability to make deductible charitable contributions due to the changes in the itemized deduction rules. And so we're seeing a lot of, for folks that are over 70 and a half, there's almost no reason not to make a charitable, qualified charitable distribution from an IRA account. And the reason for that is, as I mentioned, when you make a withdrawal from an IRA, it comes into you as taxable income. If you take that distribution and then you make a charitable contribution, which was the old way, most people did it, then you're going to have to itemize that charitable contribution on your Schedule A, and there's a reasonable chance you're going to be phased out, and you're not going to really see, well, not phased out, but you're not going to really see as much of a benefit, a full benefit of making that contribution due to the higher AGI, due to the higher standard deductions that apply. So alternatively, if you simply, instead of you forego the receipt of the income from your IRA account and you send the money directly to a charity, it doesn't get reported as income to you on your taxes, and it goes directly to the charity. So it's the same end result, but you're getting the maximum benefit of that contribution because you're basically foregoing the recognition of the income. Now, there's one really important caveat here that I think is particularly relevant to all of you in the audience, and that is that, believe it or not, when you make a qualified charitable distribution from your IRA, the custodian, Schwab or Fidelity or whomever, does not report that qualified charitable distribution. And we have seen in the past, when we have a new client review the tax return, that they've been making QCDs, but it's still getting reported as taxable income on their tax return because nobody ever told the accountant that their QCD happened. And the accountant sent a information request form during tax time, and the client didn't know enough to inform the CPA. So we're finding it more and more important that we proactively work kind of hand in glove with our clients' CPAs to make sure those types of reporting issues are avoided.
I was just going to say that 1099-R is indistinguishable. There's nothing in that 1099-R that alerts the tax preparer.
Exactly. Yeah, that's exactly right. And that's, as someone that has an MST and actually oversaw tax practice for 4 years, that's kind of a mantra of mine, is that there has to be that communication between the investment advisor and the client's accountant. So that there isn't any miscommunication, because the clients generally aren't knowledgeable enough to know what they need to tell their CPA.
How do you handle it if say, Schwab or whoever just gives you the regular IRA 1099?
Yep.
How do you show the IRS that it went the right way instead of into you and then out?
Yeah, no, it's a good question. And we actually just had a client that was audited for prior qualified charitable distributions. You can get an accounting from the custodian. And they'll show that, yes, this withdrawal that was made from your IRA went to these charitable organizations, and so you can get that supporting. Yep, absolutely. Yep.
But you have to ask for it.
Correct. And the way it gets reported on the tax return is that you have the 1099-R distribution of, say, $100,000 that comes in as your distribution on the tax return, and then the taxable amount, that's separate. I think it's 16B. You would show that actual amount that didn't go out to a charity, so is taxable. And then usually the tax software will just make a little note QCD. But the custodian will have documentation. It's not a bad idea for the individual to get the documentation on an annual basis as they do the charitable distributions. Yeah,
Michael, so what you're saying is that no one is telling the IRS computer that it's a QCD, and that what happens is that the tax return preparer, if the tax preparer is aware, writes the letters QCD or has their computer do it next to line 16B, or whichever line it is on the front page of the 1040. But from my perspective, this is a fairly significant issue, because ultimately we want to avoid tax audits. We want to minimize exposure to the extent possible. And one of the ways that you minimize exposure is when the information from the Fidelity computer to the IRS computer has QCD in it.
Right.
If that happens, the IRS computer isn't looking for it. But if the Fidelity does not have the QCD in its transmission to the IRS computer, then the IRS computer is going to be looking for that $100,000, and it checks it off. $100,000. Then it sees a taxable distribution, 0. And it sees QCD, and it says, well, that's what the client says. That's what the
Right.
taxpayer says.
Yeah, so the 1099-R actually shows it as being taxable amount not determined. So we'd say $100,000 taxable, it would say $100,000 gross distribution, and then the taxable distribution as not determined. And so that's, on the IRS's side, that's kind of that question mark, that they know there needs to be an accounting there. And so in my experience, if it's properly accounted for, we haven't had many issues, but it is something that the IRS is auditing, so you need to make sure it's getting reported correctly.
If I can just, how should I say, contribute for another second. In a situation like this, I'm just going to stand up for this. This is one of these ambiguous situations so that if you happen to be doing your tax return, or if you are working with a CPA that's doing the tax return, it's always appropriate to use a Form 8275 disclosure form, and to simply say that we are disclosing that there is a QCD, and here is the name of the charity, here is the check from the Fidelity or Schwab or whatever, or the transmission information or the wire transfer information or whatever it might be, to show that the money went to the charity. Because what happens is that when the IRS computer flags a return, it goes to a human being, and a human being takes a look at it. And if there is an 8275 disclosure form, they will look at the disclosure form. And if the disclosure form indicates who the charity is and provides some evidence that the money did go to the charity, then the second thing that the IRS person is going to do, they're going to pull the PTIN number. That's the taxpayer identification number of the preparer. They're going to pull the PTIN number. They're going to ask, how much money do we get from this particular preparer when we audit this particular preparer's return? And if the answer is a lot, I'm sorry, that's how it works, okay? And it's highly secret, so this is my best guess, but if they're not absolute idiots, and they're just going D for dollars instead of A for Albert, right? They're going to be looking at this. After all, why else do you need a PTIN number, right? And so they're going to be looking at this, so just to be aware that if there's an ambiguity, and if there's enough money to make it work, and I would say that $100,000 is sufficient money to make the effort. If we're talking about a QCD of $500, perhaps not. Doing $100,000 or more, absolutely. And in so doing, you avoid the audit, and that is huge. Because once you are in an audit situation, even though the auditor is going to be looking at selected issues, the entire return is open. And even if you are able to resolve the audit, there is always the distraction factor taxpayer has a certain level of anxiety, and it's always best to avoid it, and that's how to do it. And I apologize for taking into your time, but I think it's important for the audience to know.
Yeah.
Michael, 5 more minutes.
Oh, great. Sure. So, one other thing, my limited time that I thought I would mention that we're seeing a lot more often with our clients as a result of the new tax laws is the use of bunching of charitable contributions. So, as you know, the new standard deduction for a joint couple is $24,000, roughly. And they're getting $10,000 in their state and local income taxes, and maybe some mortgage interest, maybe not. But there's often a gap where they have to take more itemized deductions before they actually receive any benefit of it. So charitable contributions, I think, is one of the last things that layers on top of your itemized deductions that pushes you over the limit. So if you're going to make charitable contributions, most people do them on an annual basis, maybe $5,000 a year. We're talking more and more to our clients about simply accelerating those charitable contributions, and instead of making them over a 5-year period, doing those charitable contributions all in year one, so that you're getting the full value of the deduction of those contributions. Now the issue is most people don't want to do that. Most people make their charitable contributions over time. They like doing that. They don't like making these huge gifts. So the solution to that problem is the use of something like a donor-advised fund. And donor-advised funds are typically something that we have used, helped clients use in the past, typically higher net worth individuals that have huge amounts of ordinary income. They want to shelter that income or use that opportunity to really leverage their charitable gifts and maximize the impact of that gift. But donor-advised funds are now really becoming very relevant for regular Joes too. They're relatively low cost, and basically a donor-advised fund allows you to make your contributions in 1 year into the fund. The fund is run by a charitable entity, and you still have control over that fund. So you can make your distributions and your donations over time, but you get a full deduction in the year you put the money into the fund. So if you front load all of your charitable, 5 years worth of charitable contributions into year one, you put them all into your your donor advised fund, you're going to get a full value of the charitable deduction in year one, and then you can dole that money out over a 5-year period. Most charitable donor advised funds also provide investment options, so it's not that your money is just sitting there in cash. So it's really a great solution for folks that are charitably inclined but are not going to get the full value of the deductions because they're donating on an annual basis.
I know there's several of them, but is there a particular donor advised fund that you recommend to your clients over another? Or?
There's not, so we're a registered investment advisor, so we don't work for a broker.
Right.
So our clients have accounts with Schwab and Fidelity and TD and a whole host of entities. Most of those entities have pretty good charitable or donor advised funds. So from an administrative standpoint and kind of having one single pane of glass for the client when they log into their accounts, they'll see their donor advised funds with all their other accounts. We generally recommend that they use the donor advised fund of the institution. One rare kind of thing that I like to make my clients aware of is that if something happened to the donor advised fund, it's all one entity. So Schwab, for example, has a charitable or a donor advised fund. When you donate, when you put money into that donor advised fund, even though it looks like your own separate account, you're really investing in the entire pool of that donor advised fund. So every single individual that puts money into that Schwab account is really all part of the same pool. So if Schwab did something really stupid and they made contributions that they shouldn't have been making and they were sued, theoretically all those plan assets are at risk. It's not anything I've ever seen happen in, even long-term history with any large institution, but it's just something that people should be aware of. But I don't really consider it a material issue. So I think it's more of an administrative simplicity matter than anything else. Any other questions? Great. Morris here.
Morris, our next presentation is on the qualified business income deduction, and Morris will be leading that.
How much time do I have here?
About 20 minutes. I'll give you an exact figure in just a moment.
You did a great job. Thank you, everybody, for participating. Yale?
Yeah, the schedule says 35 minutes, but we can't quite go that far. We have to go a little less.
How do I work this?
Okay, so you can either use the clicker and speak
Oh,
from anywhere.
if you've got the clicker?
I have the clicker, so if you have the slides in front of you, I can simply click you through them.
Okay, that's fine. I'll let you click.
Okay.
We've got about 20 minutes, you said, till about,
4:35? Yeah, 20 minutes.
till about 4:30 or thereabouts.
Yeah.
You should all have with your booklets, with your materials, the article I wrote on the qualified business income deduction. And it's, if you are interested in this area, it's probably worth a read. And, yeah?
Yes.
I call it interim guidance because detailed regulations have not yet been issued. The AICPA, American Institute of CPAs, requested quote-unquote immediate guidance back in February. And the IRS dithered, and Stephen Mnuchin, the Secretary of the Treasury, has dithered a bit, and they said they're going to try to get something in the fall. And I can understand why they're dithering. My particular article went to 120 footnotes, and I don't like to write footnotes. I did 120 footnotes because the tax law is so convoluted, so difficult to understand, and it really came to roost here with the qualified business income deduction. And so I hope to clarify it for people here, because everybody here, unless you're an employee, perhaps can benefit from it. Yale? I'd like to talk just a little bit about tax rates. I mentioned it before. If you take a look at the bottom, the maximum tax rate for taxpayers other than C corporations, if you're a tax disfavored, if you have tax disfavored business income, the tax rate is 37%. And we'll talk about who is on the ins and who is on the outs. Basically, Trump supporters are on the in, and if you're not a Trump supporter, you're probably on the out. The effective tax rate for the QBI is 29.6%. Next. How does the QBI deduction work? How do you get your 20%? You simply figure out what your QBI income is and you multiply it by 20%. If your QBI income is $100,000, then your deduction is $20,000. And if your tax rate is at 25%, 25% of the $20,000 would be $5,000, and that's what you get. You get a mini vacation. What is QBI income? The first is the business has to be located within the geographical limits of the United States. Second, the earned income of business owners is excluded. And so basically what they're saying is that, what is a business? What is a business? A business is a certain set of activities that are performed by a number of different people Somebody has to put together a place for everybody to work. You have to get customers. You have to get photocopy machines. There's a whole lot of things that happen in order to have a business. And people who are receiving W-2 income, well, they're not particularly in business. It's the people who have invested the money, the people who are taking the risk, the people who are receiving a profit, hopefully, for their hard work. It's that profit that becomes QBI income, and we're going to talk about it a little bit more. But I think that if we can think of it in terms of the actual profit that you get over and above the personal service income that you earn. And let's go on to the next slide. Let's start with, let's drill into some of the details. Business located in the United States. There's a practical matter. It's a practical matter. Where are the employees located? Where is the real estate located? Where's the inventory located? Where are the customers located? Where do you consummate the sales? If all of these things are happening in the United States, then you have a U.S. Located trade or business. If all of this stuff is happening in Ireland, then you don't. And if some of the stuff is happening here and some of the stuff is happening in Ireland, that's a question. There are some ambiguities here. But the first item, the income has to be earned in the United States. Next slide.
No, you're already there.
Okay. Okay. The second slide is, this says that earned income is excluded from the QBI. Specifically, we already spoke about W-2 income of employees. That's earned income, it's excluded. What about guaranteed payments from partners, for partners? That's excluded too. In other words, if you're in a partnership and the deal is, I'm going to get the first $100,000 and then we split up the balance 50-50, okay? The guaranteed payment of $100,000 is treated as earned income, and the rest is not. Earned income becomes a little bit ambiguous when we talk about somebody such as a partner or perhaps a sole proprietor who is rendering services to his business or her business as an owner-manager. To what extent is this earned income? To what extent isn't it earned income? When the Tax Cuts and Jobs Act was announced, people immediately said, I am going to change my entity so that I will qualify. The AICPA says, hey, wait a second, we don't really need to change your entity in order to qualify, even though there are no regulations on point. But the point is that reasonable compensation for services rendered is excluded. Next slide. What happens, for example, if both capital and services are included in income? Let's give a couple of examples. You have an owner-manager of a retail store. They sell shoes in a shopping mall, for example. Okay, and the retail manager earns the owner-manager earns, say, $150,000. The value of his services as a salesman and as a manager is maybe $75,000. I would say that that his earned income is $75,000, and anything over and above that is not. The IRS, however, has some rules of thumb. The IRS has some rules of thumb dealing with foreign earned income. Suppose the owner-manager is working not in Boston, but in Italy, and wants to exclude some of his earnings. Under the IRS rules of thumb, 30% of the $150,000 or $45,000 represents the earned income, and the balance does not. What I suggest is, in order to figure out what's earned income, use these IRS rules of thumb, which were designed for another purpose, and take the higher of the two. Do you sense what we're talking about here? Yes, Fred.
Morris, if you have an LLC with one or maybe a couple of member managers and so forth, and they don't allocate themselves a salary,
Yeah.
they just do what they can do, they draw money out periodically.
Yeah.
Is there earned income, or is the whole thing that they get as a distribution at the end of the year, earnings and profits of the LLC?
Well, what they're getting at the end of the year are the so-called earnings and profits of the LLC. Fred's putting his finger on a very important point. What Fred is saying is, if you have some owner-managers and they're working for the business, let's assume, for example, they're CPAs. Let's assume they're lawyers. Let's assume that they sell shoes. It really doesn't matter at this point. And they're taking up money. What I would say is that the first thing you have to do is you have to say, well, how much time is each person putting in? What is the value of each person's services? And that's their earned income. And anything over and above their earned income is what would be allowed for purposes of the QBI. And if you're in a partnership situation, give everybody, if possible, a guaranteed income, if that's possible. Otherwise, try to figure it out as best you can, based on the amount of time each person puts in and the value of each person's services.
Do they take that as a draw, or do they have to make W-2 withholdings and so forth?
Okay, a partnership can't do W-2s. Partnership can't do W-2s. A sole proprietor can't do W-2s. The only people who can do W-2s are C corporations and S corporations. But one way or another, you have to tease out the earned income, and the earned income is excluded, and what's left is the profit from the business.
So a low draw, like a quote-unquote salary, unquote, from an LLC taxed as a partnership, would allow you to say, okay, this little amount here is earned income, and the great profits you earn from the business is
It's going to be treated as a guaranteed payment at the partnership level.
I'm going to go on because otherwise we'll get bogged down. I'll be happy to talk to people later. Can you go back, please?
Back?
Right, to where we are, passive income. The second point, in addition to excluding earned income, most types of what I call passive income are excluded. The QBI statute, section 199 capital A, doesn't use the word passive income. I use it as a conceptual container because it includes things like capital gains and losses, dividends, interest income, foreign currency gains, annuity income. All this stuff is not part of the qualified business income. There is one big exception, and that's rental income. And there may or may not be a reason connected with some people in Washington who have significant rental income.
Morris?
Yes, next.
Please skip the next three slides and go to slide 28.
Please do.
The limitations.
Next slide, please. We're on slide 27.
Yeah.
Limitations. Limitations on the QBI deduction. There are basically four limitations on the QBI deduction, and I'm going to go over them very, very briefly. The first limitation is taxable incomes. Next slide, please. The QBI can't exceed 20% of taxable income, and the QBI deduction can't reduce taxable income below zero. Okay? Everybody has to pay some tax. Next slide.
Threshold amount?
Next slide, we're on, go back a slide, there you go, threshold amount. Everybody, including lawyers, doctors, accountants, brokers, whatever, everybody gets the QBI deduction as long as their income is reasonably low, up to a so-called threshold amount. The threshold amount for married filing jointly is $315,000. For everybody else, the threshold amount is taxable incomes up to $157,500. If you're below the threshold amount, you can claim a QBI. If you are above the threshold amount, it all depends. Next slide. What does it depend on? It depends on whether you can get past the specified business services limitation, and if you get past the specified business services limitation, whether you can get past the W-2 and qualified property limitation. So there are two limitations once you exceed the threshold amount. What is the specified business service limitation? Well, generally speaking, if you are in a profession that takes many years to learn, health, law, accounting, actuarial services, generally consulting, or if you are in brokerage services, and that would include real estate agents, and your income is above the so-called threshold amounts, you are going to lose part or all of your QBI deduction. Next slide. There are two types of professional services that are specifically included in the category of tax-favored professional services: engineering and architecture. Now, this is, I'm not saying that this is good, I'm not saying it's bad, but I think it's a little bit troubling that if you are in a 19th century type business, you're a manufacturer, you have a coal mine, those things are tax favored. But if you're in a 21st century business, the type of businesses that we are all in, well, you're in a specified business that's tax disfavored. But there's another issue that is, to my mind, even more troubling. And that is that it is very difficult in many cases to tease out a tax-favored business from a tax disfavored business. Let me give you an example. Taxpayer assembles real estate lots. He's a developer. He obtains the permitting, he gets the plans, he constructs the office building, and he rents it out. That's great. But suppose he also assembles investors. Suppose these investors relying largely on the taxpayer's reputation. At this point, is he engaging in brokerage? Is he engaging in consulting? Is the fact that the investors are relying on the taxpayer's reputation, does that make his business a tax disfavored? It's hard to know. There is a huge amount of ambiguity in some of this. Next slide.
Skip one and go to W2.
Okay, move.
Oh, you're there.
Okay. Let's suppose that we get past the specified services and the ambiguities connected with it. Then there's a final hurdle that we have to get through, the W-2 and qualified property limitations. Basically, the QBI deduction cannot exceed 50% of W-2 wages, or 25% of W-2 wages, and 2.5% of the unadjusted basis of so-called qualified property. Qualified property is property used in a business. Let's just focus on the W-2 wages, for example. Suppose you have somebody who, two people, side by side, operating on Main Street. One man, and they both are in the computer business, and they both do software. One person is a Schedule C, he's a sole proprietor, and he runs his business as a sole proprietor, and he has $1 million of income. And let's assume this is after taking out a reasonable amount of, this is after a deduction of earned income. So this is his business income, his profit, it's $1 million. And the man next to him on Main Street is operating as an S corporation. And as an S corporation, he also has $1 million of subchapter S income after taking out a reasonable salary. Let's say his reasonable salary is, he has a W-2 of $500,000, okay? The first man, the sole proprietor, doesn't have any W-2 income. Second man does. He has $500,000 of W-2 income. So the sole proprietor's QBI deduction is limited to 50% of zero, which is zero. The man with the S corporation, who has $500,000 of W-2 income, his QBI deduction is limited to $250,000. And so when the guy with the schedule with the S corporation figures his QBI, 20% of qualified business income, $200,000. Limitation, $250,000. So one person gets $200,000 as a QBI, the other person gets zero. So if you're involved in this area, you need to you need to be aware of these issues. And then, of course, how much time do we have, Yale?
1 minute.
Okay. There are issues involving with the aggregation of similar businesses and the bifurcation of businesses. I'm going to skip that stuff because it's all in this booklet. I'd like to just leave you with one thought. There are ambiguities. The first ambiguity is how much is earned income. The second ambiguity is what happens if you have both a specified business and a non-specified business. One is tax favored, the other is tax disfavored. What do you do if capital is an important contributors to income, such as if you're in real estate and so on? How do you deal with situations like that? And I have just two takeaways. It'll just take me another 45 seconds. First, clarify on the tax return why the taxpayer is entitled to the QBI. Because somebody who's taking a deduction and they're trying to avoid paying taxes on $60,000, $70,000, $100,000, those people are going to be audited. And so what you need to do is you need to put right on the tax return, you have to have a certification. It's not in the statute, this is Morris Robinson talking. You need a certification why the taxpayer is entitled to it, and you slap it as a rider to a Form 8275 disclosure form. That's number one. Number two, that's the second, and this is the second takeaway. Never allow a taxpayer to lose their QBI deduction because they had insufficient W-2 income. If there's appropriate tax planning, you can always redo your business so that you have so that you're making an S election, and once you have an S corporation distributing sufficient income to the taxpayer, there'll always be sufficient W-2 income. So those are the two takeaways. Make sure you avoid the W-2 limitation, because that's simply a limitation that affects people who avoid appropriate tax planning. And just as importantly, make sure that if there's a significant QBI deduction, that the deduction is fully supported in the tax return through an appropriate certification. And thank you very much for your attention.
Thank you. We'll meet again in 15 minutes at 4:52 or so. If Attorney Alex Rodriguez is here, please raise your hand so I can meet you during the break. Is he here?
Attorney Rodriguez is outside.
Oh, he's outside. Okay, I'll meet him. Thank you. I'm pleased to introduce Attorney Alexander Rodriguez. And with a name like that, it can be hard to work on search engine optimization. But the way I found him is that I have become aware that cryptocurrency has really become a major emerging player in the financial markets and is also a focus of IRS tax enforcement. And I was wondering who could advise us on what we need to know. And I found that this fellow to my left has a new firm called Blockchain Legal. He has a few attorneys working alongside him in that firm. And Blockchain Legal is a place where anybody with questions about this specific issue can go for advice. And I'd recommend that you listen carefully to what Mr. Rodriguez has to say for us. Go ahead.
Well, thank you very much. Thank you all for being here. The blockchain space is very hot right now. It's blockchain slash cryptocurrency. It's all over CNBC. It's all over the news. Last year, it skyrocketed. There's a huge industry now that is focused on one new tech with the blockchain technology, and also on capital formation strategies that haven't been used before with the blockchain technology. With that comes a lot of gray areas, and what we do at our firm is we help, for the most part, entrepreneurs and also investors figure out how to navigate those gray areas with the best practices that are being used in an industry that isn't fully regulated yet, but what shows their intentions to hopefully try and protect investors. So I will, so first question here, who in the room owns some form of cryptocurrency? That's actually good, because I'm going to start off first with cryptocurrency basics and what it is. So some definitions. I spoke about the tech, right? The tech is called digital ledger technology. So we all call it blockchain because that's the technology under Bitcoin, but blockchain is just one form of what we call DLT. The easiest way that I explain this to friends and family is think of a Google Drive or a shared Excel spreadsheet that you could simultaneously update with somebody else and add some cryptography, which what that means is add some encryption to it. And that's the basics of what DLT is, or what blockchain is. we have blockchain, but we also have other forms of DLT like the Tangle and the DAG infrastructure. Then we have cryptocurrencies. That's a big buzzword right now. But what that basically means is that cryptocurrency is a token that's basically used to access that Google Drive, or how it's implemented in any form of business. So, for example, there are some businesses that are implementing blockchain technology to accessing medical records. Instead of those medical records being stored on a centralized database, the idea is to help hospitals store them on a decentralized database, whereas somebody who wants to give somebody else, let's say a doctor, an attorney, a third party, access to their healthcare records, won't have to necessarily go and contact Optum, for example. They could go and buy a token that will give them access to that person's medical records in a decentralized fashion. The hottest part about this is that it changes how we look at property rights. As of right now, Facebook, for example, owns our data. They have access to all of our data. Whenever we search something on Facebook, it's all stored on Facebook servers. We see how that could backfire. The idea with blockchain technology is to take away that ownership from a centralized provider and spread it across multiple computers with encryption so that it can't be hacked. And as of yet, Bitcoin, which as a cryptocurrency reached over $19,000 last year, cannot be hacked, and it's been around since 2012. As of right now, this past year, yes?
I've heard, for example, that people have raided banks like Mt. Gox and got millions of dollars of,
Yes.
of Bitcoins. How is that possible if it can't be hacked?
So that's a great question. Think of the internal system of Visa, right? People don't tend to target Visa and try and hack Visa's internal system. They look for weak points. And those weak points come in on and off ramps of either exchanges like Mt. Gox or for example, gas stations. When you swipe your card, that's how you use a credit card. So what's usually compromised isn't the actual Visa technology, but the place where you use that card, because it's the weakest point. So hackers tend to focus on those weak points to take people's information and use it against them. Hope that answers your question. But from a tech standpoint, it's encryption. It's as secure as it gets, and it can only be hacked by quantum computing. That's a big buzzword, and we don't expect that to happen for another 10 to 15 years. So Bitcoin reached 19,000 last December. Then it dropped. Now it's currently at around $6,000 or $7,000. A ton of people call it a bubble, and I mean, to a certain extent, I kind of agree. Whereas what happened last year when the market shot up, it was what we call FOMO, fear of missing out. Just people saying, wait, my cousin, my friend, my family member is making money at this. I should invest into it too, without actually assessing the actual value of that cryptocurrency or of the underlying tech of each cryptocurrency. So the actual market has stabilized over the past 6 months, where it has its ups and downs. But as of right now, it has funded tons of companies to help develop thousands, or over 1,000 active cryptocurrency projects. There's a lot of fraud in the space. So what I always tell friends is, hey, if you want to invest into cryptocurrency, don't put any money that you don't mind losing in there, because you can't just walk into that market and not be knowledgeable about it, because you might lose your money. It's very similar to investing into stocks. If you walk into the stock market and just buy random companies because you've heard some buzzwords, you might actually lose your money. And in this market, it's unregulated, so it's even more dangerous. But you could acquire it, right? How do you acquire it? You could pay for goods and services. There are plenty of websites that let you buy stuff using Bitcoin and other cryptocurrencies. You could purchase those cryptocurrencies at exchanges or on websites like Coinbase, for example. You could exchange with other people. So, for example, I have a cryptocurrency wallet. I could actually send you a certain cryptocurrency and you send me something similar or something of similar value to it, and I just exchanged it with you. And those actual transactions is us exchanging value without a third-party bank seeing what is happening or actually monitoring that transaction. It's done through a distributed system where there's no intermediary that is standing in between me taking out my cell phone and sending you some value. Or you could earn cryptocurrency through something called mining. What that is that you use specialized computers to solve those some complex codes to help solve these long mathematical problems that will essentially mine and or create new Bitcoin. Yes?
So you're saying that one way to obtain Bitcoins is I have a smartphone, you have a smartphone, you can just transfer
Yes.
Bitcoins to me onto my smartphone if you know how to reach me and so on.
Yes.
It's as simple as that.
Simple as that. And it's
no
not
and no bank is involved.
correct. As simple as that.
I can understand why taxing authorities around the world are concerned.
Yes, correct, correct, and that's a huge issue here because how do you basically trace what has happened, and how do you trace the exchange of value? Like we all assume that we'll be trading value under $10,000, of course, in cash all the time, and we have accepted that that's okay, but when it comes to cryptocurrency, it's a bit harder to trace. But specifically, which I'll talk about later, it's actually possible to trace every single transactions. And in some instances, Bitcoin specifically is a lot more transparent than most banks. So just to jump into tax purposes, and I am not a CPA or a tax attorney, I focus on blockchain tech, but for the actual basics, I think it's important for us to know. So I'll start it off with some questions. So for tax purposes, how do you classify Bitcoin? A security, property, commodity, or something else? Any guesses? Yes?
Property?
Correct. So
What's the answer?
it's a property. It's a property, yes. So as property. What's very interesting about this specific question is that the SEC will they classify it as a security. The IRS, they classify it as property. And the CFTC, they classify it as a commodity. So there are multiple agencies that are trying to regulate cryptocurrency at different stages of its lifespan and for each different use, which is what I basically help clients with to figure out how to try and comply with each agency's requirements. So a quick example, if somebody uses Bitcoin or a 0.0001 of a Bitcoin to buy a sandwich, or let's say 10 Bitcoin, or cheap house, but let's say 20 Bitcoin to buy a house, how do you recognize it? Well, you actually get the gain or loss from when you actually bought it, from the actual value of what you bought it for, to what it's worth when you sold it. And there are actually, there's one IRS notice specifically, which is the last one there, 2014-21, which answers a lot of questions as to how to basically treat cryptocurrencies. But that's the only guidance that has been put out so far. So next, which scenario is not a taxable event? Bitcoin to altcoin. So an altcoin is, let's say, some other cryptocurrency like Neo or Ethereum or something else is not Bitcoin. So that one. Altcoin to altcoin. So let's say Neo to Ethereum. Bitcoin to fiat. Let's say Bitcoin to the US dollar. If you gift somebody over $14,000 or now $50,000, or a wallet-to-wallet transaction. Any guesses?
Well,
Yep. So everything else is a taxable event. But if you transfer it from, let's say, my wallet to some other wallet that I also own, it's the same thing as you transferring funds from bank to bank. Yes?
What is altcoin to altcoin?
Altcoin to altcoin. So as I had mentioned, there are over 1,000 cryptocurrencies. The term for everything else but Bitcoin is an altcoin. So there are over 1,000 coins, basically. Some of them have funny names like Neo, Tron, and just all sorts of names that people just, that they come up with to make their own cryptocurrency. Yes?
So in the wallet-to-wallet, non-taxable transfer, if the recipient has a wallet, you're buying a house from that person, you transfer your Bitcoin from your wallet to his wallet.
At that point, that should be a taxable event because you have.
So what you're saying is, if you transfer any Bitcoin or to yourself,
Exactly.
then of course it's not anything different. There's
Exactly.
no taxable.
Exactly. The overall purpose of this slide is to show how complicated it is, right? So, for example, somebody could, if you want to buy, for example, some sort of altcoin because you met the founders of that altcoin, think of it as a startup. You meet the founders of a startup at some event, you like their project a lot, you want to invest into them, and how you invest into them is by buying their cryptocurrency. At that point in time, in order to buy that cryptocurrency, you have to at first buy some on-ramping coin, which is usually Bitcoin. So that's a taxable event. And then when you send it to somebody else, when you exchange that Bitcoin for that altcoin, it usually takes like an hour or two, and there might be a fluctuation in price at that time. So you have to calculate that fluctuation in price of when you bought it and when you transferred it to buy a separate altcoin. And then for that altcoin, you have to, if you want to off-ramp it, trade it back into Bitcoin and then into fiat. So there's multiple steps in it, and each one is supposed to be a taxable event.
Thank you.
So, I mean, if you go on Reddit, you'll find all these people saying, well, it should be a like-kind exchange, right? So, and I mean, it does make sense, right? Because one coin is used, for example, Bitcoin, to send value. And if you buy Ethereum, it's to actually use that in somebody's app, let's say an app on the phone, right? It's just to use the app on the phone, and that's why you buy it. So, or let's say that's a bad example, but let's say if you trade Bitcoin for something like, let's say Monero, which is two just pure cryptocurrencies. At that point in time, it seems similar, right? So I'll ask you guys. So cryptocurrency, do you think that it's a like-kind exchange? Yes or no? No, you're right. It's similar to gold and silver. So you could actually exchange a gold necklace for some gold earrings, and that's a like-kind exchange. But if you exchange gold and silver, it's not a like-kind exchange, and that's where it gets very complicated. Yes.
Just a clarification that we're talking about exchanges before December 31, 2017. Today, 1031 exchanges are more limited, and I don't think that, I think you're limited to real estate.
Okay.
This applies to 2017.
Okay, yeah, so even then though, it is still not, like an exchange, but it's just like,
It still would be.
gold and silver, yeah.
The answer's still no.
Yeah, answer still no.
And incidentally, with regard to gold and silver might not be exchangeable either. In fact,
Yeah.
there are, I had to look it up for a client, there are revenue rulings.
Yeah, that's, that's what I meant here, that the gold and silver are not interchangeable as a like-kind exchange. So, and neither are any sort of cryptocurrencies, even though their uses are very similar in some cases. So if you mine for profit, so if you use your computer to solve solve these long and complicated math problems that will result in the generation of new Bitcoin, whereas the person that mines it actually gets some Bitcoin himself. It's very similar to you going out and mining gold, at which point if you find gold, you keep some of it yourself as well. So if you mine, how do you report income? 1040 or self-employment?
Self-employment.
Self-employment, correct. So self-employment. Huh? Yeah. Sorry, I had missed the actual schedule there. So self-employment, Schedule C, right?
Yes.
Yeah, there you go.
Which goes in 1040.
Yeah, exactly. Yeah, sorry. Yeah, that totally flew over me. But yeah, so when you mine Bitcoin, you do have to pay some employment tax on it. But what happens is that most people, and why this is constantly raised, is that most people have not even thought about that at all. And most people that have been mining Bitcoin for years never thought to ever disclose it because they thought that it's actually not traceable. So there are, just to be frank, right? There are some enforcement issues now. Well, in 2016, the IRS came and they approached Coinbase. Coinbase is one of the largest on and off rampers of cryptocurrencies out in the world right now. They approached them with the John Doe summons and said, well, I want information on half a million customers. Coinbase fought back, and they were forced to actually reveal for 13,000 customers, which is still a substantial amount. I think the standard that they use there is if you had transactions of more than $20,000. But it's worth noting that IRS took a similar approach for offshore banking, and that actually changed the whole the whole offshore banking structure. Yes.
The difference, though, is that with Coinbase, the cutoff was $20,000. When dealing with UBS, the cutoff was just over $1 million.
Yeah. So, that just opens up a huge can of worms. And what this has basically done is that it has sent a shilling effect through the whole cryptocurrency market, whereas the actual market has, been sliced to a fourth or a third of what its peak was in December because every regulator is trying to figure out how to deal with it, and no one wants to get caught in the crosshairs, because even though somebody wants to report how much income they have received or what the actual basis price was for a certain cryptocurrency, if you're a trader and you trade so much, most of these exchanges, there are over 100 exchanges that most of them don't keep any of that information, and to ever access it is pretty much impossible. You have to guess or do weighted cost averages, because it's not like there are just one or, let's say, 2 to 5 exchanges where you could buy a stock. Here there's over 100 exchanges that all sell, let's say, Bitcoin at different prices. So you could do some sort of weighted average costing, but for each single trade, when you trade so many of them and buy stuff with it, it becomes difficult. And how I had mentioned in the beginning that banks might not like, or banks, or let's say most governments don't like cryptocurrencies because it's untraceable. Well, that's actually not true. When you have a Bitcoin wallet, it's assigned to a certain person. Depending on which service you use to either buy your Bitcoin and or create that wallet, that your personal information is usually out there. Unless you're doing something that's extremely sketchy, or like using some sort of service which exists that don't have any sort of like reporting requirements. Your information's tied to a certain account somewhere when from when you either purchased or sold Bitcoin, or from when you created that wallet. What that means is that, just like I had spoken about how this is like a shared Google Drive document that everybody has a copy of and everybody has access to, every transaction that you do with Bitcoin is recorded. So if I have a wallet, I have a wallet address. Every transaction that I've ever done, it's all numbers, but it's all public information, where anybody could download that wallet and see everybody else that I've sent money to and the actual value of how much I've sent to each person. So in a sense, it might be even more transparent than banks, as long as you could actually link the people up to those wallets. And there are startups already that have been doing that, and the IRS service or the IRS is using that software to try and unmask who owns certain wallets, to be able to trace how much they've actually owned or have made with cryptocurrency. So we don't know where that's going to go, but that would probably go somewhere, especially if people made, let's say, millions of dollars trading Bitcoin. There are some possible solutions here. They're just best guesses as to what we hope will happen. One of them is that they do some sort of voluntary disclosure program, so we hope for. We don't know if that's going to happen or not, similar to what has been done for offshore bank accounts. It might happen, it might not. That might solve problems, because remember, what people have been doing since 2012, there was no way to easily record transactions, and it was very difficult for most consumers. The same thing goes for all the companies that have launched these cryptocurrencies. Many of them have been blatantly breaking SEC regulations in their capital formation strategy. Most of them, though, it's not because they're bad actors, just because it wasn't regulated. So they were just trying to do stuff above water as possible. The ones that have gotten in trouble are the ones that have been making fraudulent statements. People have gone as far as to put pictures of well-known celebrities on their website and say that they work for that certain token or that certain company, and they have suffered certain consequences for that. But the ones that haven't been as fraudulent from the SEC side, we also hope that they do some sort of disclosure program for them as well. And scenario 2, to make a new asset class for cryptocurrencies. Yes?
I apologize. I'd like to just let people know that with regard to voluntary disclosure, in addition to the normal voluntary disclosures such as the offshore voluntary disclosure program that people are familiar with, IRS has had a voluntary disclosure program, and the states all have voluntary disclosure programs that well preceded this. The basic voluntary disclosure is if there is no problem, rather if there's no particular program, you simply disclose voluntarily. you should do it with somebody who knows how, but the basic idea, you just disclose voluntarily. There is no particular program, and you say there is no particular program, but you say there's still what you still want to do is you want to make a voluntary disclosure, and you want to indicate that you didn't quite know what was going on, you didn't quite know what you were doing, if that's possible. And if not, you have to deal with that. But the point is, if you make an appropriate voluntary disclosure, you can avoid the problem. The situation where people really get into trouble is when they started out on the wrong path, and they say, well, it's too late to go back. Those are the people who get caught. If they get caught, some of those people will be punished. But if somebody knows that they've done something inappropriate and they want to make a voluntary disclosure, I've never had a situation where people voluntarily went forward and they were decent people that we weren't able to get them off the hook, even though there wasn't a particular program. Thank you.
Yes. You have some class for cryptocurrency.
You?
Yes. So that second point on the bottom of the slide mentions the possibility of a legislative solution, federal legislation that would make Bitcoin and altcoins as separate asset classes. I think that's a good theoretical idea. Obviously, the devil is in the details, but it would make compliance, which would be consistent with the voluntary disclosure approach, easier if people could have a simpler approach to reporting their gains and losses. Alexander, can you please skip to the last slide, which talks about recommendations in the interest of time?
Yes. As one possible solution is to make a qualified amended return. That is one option that you can do. There are some limits there, specifically because there was a John Doe summons in the Coinbase that would not qualify there. I'll just skip over this, but that is one solution. And then a second one, which is a common question that I get from our clients: should I move to Puerto Rico? There is a typo in each one of your slides. So there are a few issues that was not as easy to just pick up and move to Puerto Rico. And you do have to live there for a long amount of time. You have to buy a house within 2 years, have to have a driver's license, have to have a local bank account. It's so on the slides it says something else, but that's incorrect. But the issue there is what was gain, and the sort of gain that happened while you were in the U.S. probably would not qualify to be subject for this. In the interest of time, I'm going to just jump straight into recommendations. You want to ask clients if they own or trade cryptocurrency or plan to do so. If they already own cryptocurrency, you ask them or ask them if they have reported it or not. If they say no, you should consider to involve an attorney or to prep a voluntary disclosure, which I fully agree. I mean, that's one option right there. And to advise them to keep track of every trade. There are startups now that basically help people keep track of every trade that they do. The price of the date bought, sold, sent, and received, and the cryptocurrency price in US dollars. And if the client plans to start trading cryptocurrency, it's important that they plan with us as professionals, basically, to make sure that they don't make any mistakes in regards to what they have to, the information that they have to collect. Myself, it's all in there. It was a pleasure to be here, and I thank you for just joining us on this afternoon.
If there are no more questions on this topic, we'll move ahead to, to foreign-derived intangible income and the GILTI guilty deduction as well, global intangible low tax income.
Are there any questions on this? Cool, thank you.
Thank you very, very much. That was very informative, very interesting, and thank you very much.
And we'll try to keep this to 20 minutes so that people can leave and catch their trains.
One second.
One slide.
Yeah. Here we go. We'll see if we can't get you guys out a couple of minutes early, especially since many of you participated in the Stump the Speaker, and you got an extra half hour CPE for that.
So several people mentioned that they have to catch a train.
Okay, well, thank,
Anyone who needs to leave can leave. If you were here for 4 hours of CPE, you can claim 4 hours of CPE.
absolutely, absolutely. And there's another item in your packet. It's called tax-favored foreign income planning points and traps.
It's on the left under the speaker evaluations, and that's a good segue to remind you that during the last few minutes, maybe is a good time to start the speaker evaluations so you can leave on time. Go ahead.
And we're going to be talking about the foreign-derived intangible income deduction and the global intangible low-tax income deduction. And forget the acronyms, which are a little bit scary. Basically, slides, what we're talking about is foreign income where your clients can get a substantial deduction if they plan it right. And again, planning is important. The if piece is basically you have to be a C corporation. But if you're a C corporation, next slide, you started off with a 21% taxable income rate. But if you qualify for for selling property or services abroad as a U.S. company, the tax rate goes down to 13.125%, 13.125%. And if you are selling property or services abroad through a subsidiary, through a foreign subsidiary, you can reduce your effective tax rate on the subsidiary's income, and you're going to have to report it now, to 10.5%. And so that's huge. That's huge. And so we're talking about the foreign-derived intangible income deduction and the global intangible low-taxed income deduction. And who benefits? All C corporations who sell goods and services in global markets. If you're a U.S. company and you're selling goods or services in global markets, and we'll talk about that later, you get the deduction. It's as simple as that. Yeah. And most smaller businesses in the United States, here in Boston especially, you know, we have over 150 direct nonstop flights to all European capitals, to the Far East, to Tokyo, to Hong Kong, to Tel Aviv, over 150. Global business is here. It's now. Who benefits from the GILTI deduction? C corporations who have a foreign subsidiary. What's a foreign subsidiary? You're doing business in Ireland, you set up an Irish corporation, and bingo, you own 100% of the Irish corporation, you have a foreign subsidiary. Okay? And so, depending upon how you do work, let's talk about it just very, very briefly. Earlier this week, a Boston firm of structural engineers are doing some work in Ireland. If the structural engineers simply sell their services, they're building, you know, the structure for the skyscrapers in Dublin. If they submit them, if they do the work here and ship the plans overseas to build the item in Dublin, they're entitled to the FDII deduction. All they have to be is organized as a C corporation. And if these guys are not organized as a C corporation, and if they don't want to be organized as a C corporation, if they set up a C corporation to handle this particular deal, and they allocate, services or whatever, employees or whatever to handle this particular work, they probably can get the deduction. All that's necessary is a little bit of tax planning. And if it turns out that these guys are doing a lot of work over there, and they may have 2 or 3 people working over there, well, you set up this Irish structural engineering company in Ireland, and then the profits from the foreign operation are subject to a tax of 10.5%, and that's it. And if it turns out that the foreign corporation is paying taxes in Ireland, and they should, because they're doing business over there and they're making money over there, if they do, then 80% of the taxes paid to Ireland are creditable under the foreign tax credit. They can reduce the income of the U.S. corporation dollar for dollar, and as a result, the U.S. corporation pays 0 tax. And so this is a tremendous benefit, and next corporation, and it's something that people need to be aware of, and it's not that complicated. It's available to C corporations, but there are several exclusions. The first exclusion is, let's talk about the foreign-derived intangible first. First exclusion is controlled foreign corporations are excluded. The foreign corporation, the controlled foreign corporation get a different deduction. They get the guilty deduction. The FDII deduction is when the structural engineers do the work here in the United States, okay? And they can't do the work as a foreign branch. If you're doing work here in the United States, and you can't, you're going to get your deduction. If you send a bunch of people to Ireland, then you got a foreign branch, and so you don't get the FDII deduction. But the deduction is 37.5%, and it's really as simple as that. Do the work here, sell it abroad, get the deduction. Next slide. Suppose that these people want to send some people over to Ireland, okay? In addition to doing the work here, they want to have several people on the ground to make sure that the building goes up right, or goes up correctly. They want to make sure that the building is built in accordance with spec, because that's what the owners want, okay? So what you need to do is you need to set up a controlled foreign corporation. It sounds complicated, it sounds intimidating, but really all that's involved is you set up an Irish corporation. We just set up a corporation in Massachusetts for some folks in Saudi Arabia earlier this week. A small firm in Ireland can do the same for an Irish corporation. It's not necessarily a big deal. A controlled foreign corporation means that the U.S. people own more than 50% of the value of the shares. They own more than 50% of the control of the voting power. But it's really, but if you're setting up this Irish corporation and you own 100%, then you've got a controlled foreign corporation. The second point is that the foreign corporation can't be involved in the effective conduct of a trade or business in the United States. your corporation here in Massachusetts, your engineering company, doesn't do the work over in Ireland. You've sent a bunch of people over there. They do the work over in Ireland, okay? And you can't have a branch operation. You can't, if you're doing work in Ireland, you can't set up your corporation in Bulgaria. The Treasury doesn't want you to play a shell game, where you incorporate in one country and you're doing the work in another country. They want you to do, they want your foreign corporation to be in the country where the work is being done. A branch is when you're organized in one country and you're doing work in another country. It's as simple as that. So you avoid shell games. Third, you can't earn your money through dividends, and that's similar to the shell game business. If the foreign corporation is located in Bulgaria, and the foreign corporation is getting a dividend from another company in Ireland, well, that's part of a shell game, and they don't want any of that. So if you're doing business in Ireland, set up an Irish corporation, have a Massachusetts company as the owner, a C corporation, and you've got your guilty deduction. And like I said, once you factor into the foreign tax credit, you can wind up with a zero tax in the United States. And that's what we were trying to talk about at the very beginning, saying that we're setting up a new territorial type of tax. What is a territorial type of tax? It's where the Irish tax the work that's being done in Ireland, and if you do it right, the U.S. government doesn't. That's territorial. Next slide. So what is engaged in the trade or business in the United States? If the employees are in the United States, if the office is in the United States, if the personal property, the photocopiers are in the United States, and if you're selling to U.S. buyers, then you're engaged in the trade or business in the United States. But if you want that guilty deduction, if your employees are in Ireland, the office is in Ireland, the photocopier is in Ireland, and the project is being sold to people who are the building owners are in Ireland, or the building is going up in Ireland, then you're not engaged in the U.S. trade or business. Next. The foreign branch is, as I said before, where you were incorporated in one country, but your employees, real estate, personal property, etc., are in another country. Next. So to be a controlled foreign corporation, it's, as I said before, it's not very difficult. You just need to be organized as a corporation under foreign law, and you have to have more than 50% of the value of voting power held by U.S. persons, and a U.S. person can be a U.S. citizen, U.S. resident, a U.S. corporation, organized corporation. And as I said before, whether they don't want branch income, no matter whether you're doing the work in the United States or doing the work abroad, and they won't want dividends. They want work from the business itself. Next slide. And the deduction, as I pointed out, 50%. And next slide. So when I spoke to you before about the QBI, I said, you know, we need to make sure that the income is defensible, because the government is going to be auditing the stuff. They're looking at the low-hanging fruit, and so a guilty is probably better than FDII, because you don't have to justify what you're selling. You're not concerned with the identity of the buyer. You're not concerned with the final use, consumption, or disposition of property. Keep going, next slide. Next slide. All you're really looking at is, for a guilty deduction, do you have a foreign corporation? And is the foreign corporation actually operating in the foreign jurisdiction? For FDII, it's a little more complicated. You need the identity and location of the foreign buyer, identity of the property that's being sold, a description of the services, a description of the foreign buyer. There are a few requirements, and my suggestion is that if you're going to do this, you should document your requirements ahead of time. Document, because what is going to happen is that people leave, especially, a firm of structural engineers. They're doing the work in 2018. They're taking the deduction in 2019. The return is audited in 2021, and by that time, some of the engineers will have gone. Some of the people who are in the back office doing the accounting work and the bookkeeping work will have been gone. The people who were involved in working with the clients in Dublin may be gone. So get the information now, because realize that the government is going to be auditing this stuff, and since they're going to be auditing it, get the information now. That's the takeaway here. And the second takeaway, and I'm just going to close at this point, is it's not as complicated as it seems. The QBI is much more complicated than this. The QBI went to 120 footnotes. This only went to 32. And I think I covered them both approximately as well.
And that's because the QBI section has more ambiguities. There's also more language. It's a longer thing to read, and the regulation on it will be longer. And this FDII and guilty, main section is 250. Then there's a definition of controlled foreign corporation 951 Cap A, and that's it. It's not as complicated. I agree with that, Morris there. Then you want to make some concluding announcements?
Debbie, want to make some concluding announcements? But first, I, as a speaker, would like to applaud those who stayed to the very end. Thank you very, very much. We hope that it was worth the time. But this is what it was all about back in January, and we appreciate evaluations.
Speaker evaluations right here. Please fill them out.
Yes. So please remember to fill out and turn in your CPE forms. We would also appreciate your opinion about whether next year we should run this event in the morning rather than in the afternoon. We have reserved a date of June 6th, 2019, which is before the school vacation season, and that might help prevent some of the problems. But we are seriously considering moving to a morning event, which has its own commuting problems, but it would be hard to exceed the horror stories that we've heard from several of the guests today. So thank you all for coming. And I think Morris wants to add something.
Yeah, we just want to make sure that if you need CPE, there's a...
Yes, when you turn in your CPE forms, if you give your form to Joseph Kelly, he will give you your certificate. And thank you again for coming and for staying.